All right. Welcome. Let's start. Just a couple of announcements before we start. We have to abide to the code of conduct. It's in the program. First off. Second, the rules of the game are 20 minutes per presenter, 20 for discussion, and 20 open discussions. When you ask questions, we want to ask you to ask with a microphone because this is right now being streamed, okay, on YouTube. All right, so without further ado, first presentation is by Payman. Floor is yours.
All right, thank you so much for having us. This paper is about monetary policy, and just a very short context for what we're talking about. Obviously, we know monetary policy affects the short rate. That's sort of the primary thing that most people have been thinking about. More recently, we started to think that they do a lot of other things. So embodied by this quote by Ben Bernanke that 98% perhaps of what they do is not even action, but actually talking. Some of the policies that you may have in mind are these unconventional type of policies, forward guidance, asset purchases, other types of communication. And we're going to try to think about those a little bit and how they affect asset markets. One thing that's related is that when you start to think about these policies, they can impact asset markets in more pervasive ways than perhaps the short rate can. And so there's this idea that uncertainty is modulated potentially by what monetary policy does. For example, if they change their rule, if they plan to intervene in a market, if they announce that they're going to do that, et cetera. So against this backdrop, this is the type of questions that we're after. You think about all these unconventional policies, they seem to affect something like beliefs about the future, but also asset markets and risk premia in various ways. And then you're back to this sort of classic puzzle in asset pricing when you have beliefs and risk premia together. How do you separate them? And separating them is actually important if you want to identify how those policies work. Okay, so that's kind of one question. The second question is now you have all these different types of policies. Okay, you want to figure out how they work. Is there some way to potentially summarize them, maybe reduce the dimensionality? And there's been some proposals out there to, for instance, use the yield curve. All right. And that's pretty powerful. You just look at how the yield curve moves overall. Is that a legit idea or not? And these things seem to be related potentially because you're starting to think about whether or not you can restrict attention to certain type of risk and risk premium or not. What we're going to do is unify this under one umbrella, which I'm going to call long run neutrality. All right. So that's the focus of this paper. And for us, long run neutrality is like an asset pricing version, not the conventional macro version that we think about, which is that does marginal utility move in a permanent way or not in response to monetary policy? So that's the question. Why do we look at this? It turns out to be the answer to those questions that I asked at the beginning. All right. So if it holds, then you're able to identify the sort of, in some sense, I'm going to make precise monetary policy, all these different types of monetary policies that affect risk and beliefs at the same time. And you're able to use the yield curve as sort of a sufficient statistic if you want to do things in more reduced form. Okay. On the other hand, if it doesn't hold, which is what we're going to show, then those two things are not possible. All right. And then we're going to quantify a little bit how bad it is. Okay. All right. So what is long run neutrality? Just to give you like a little bit of a background. So we're going to be working with a real SDF. All right, that's important. So here it is, S. We're going to start with this concept, which is essentially statistics. So there's not too much content in this, that I can decompose this SDF into a permanent and transitory component. All right, just like you would do with any stochastic process, you can do this. It's just multiplicative. So you think of these permanent and transitory multiplying each other. Okay. The transitory is going to be a function of time and the stationary state vector in the economy, and the permanent is a martingale. All right, so that's what I'm going to call H. So long run neutrality says that H does not move in response to monetary policy. That's what it is. Okay. All right, so they can affect the SDF through X, for example. They can affect risk premia through their effect on X potentially. But there's a particular sense in which they don't affect the SDF. Okay. So what does it mean? It's kind of helpful for me to think through like just a couple example models, and you can see this very quickly how this works. So imagine, now this may not be true, but imagine that this sort of conventional macro neutrality holds, which is that real stuff is not affected in the long run by monetary policy. And the way I'm going to formalize this is say consumption, the distribution of consumption in the long run is sort of exogenous to monetary policy. Okay, now let's think through some models. Like, what does the standard sort of new Keynesian model with CRA utility look like? This would be the SDF in that model. And you say, does long-run neutrality hold? Yes, because the only way it couldn't hold is if consumption responded permanently to monetary policy, and you just said it doesn't by assumption. That's what I'm telling you. Okay, you generalize this in various ways, and it kind of continues to hold. So if you add heterogeneous agents, what that tends to do in the way we formulate models is it adds this transitory component, which is usually a function of the wealth distribution across agents. And that tends to be stationary, the way we write our models. And so the main conclusion is going to be still, if you want long-run neutrality to fail, it has to be about aggregate consumption in the long run. And under conventional monetary neutrality, that is also not the case. Okay. So you could do things like add habits and various other ways. And those, a lot of things that we like to think about, what they're going to do is add this transitory component. Okay. One thing I think is interesting, I'm not saying this is the model, but it's a way to think about, is that if you imagine that there are things like uncertainty or news that the Fed does, and those shocks are priced, the way we like to model that a lot of times is with Epstein-Zinn utility. And so what would happen in that world is an SDF like this, and the continuation utility U is in there, news affects that. And then if you look at this carefully, it's kind of interesting that that green term there is a martingale, all right? So that green term is going to be actually the entire permanent component in this case where C is kind of stationary or the long run is exogenous. And monetary policy by doing news or modulating uncertainty can still affect the permanent component of marginal utility, all right? So that's kind of like an interesting case where the conventional neutrality and long run neutrality for us are potentially different. Okay. So just stash that away as a potential insight. So if you like Lucas and you like conventional neutrality, but you want to sort of square with what we're saying, maybe that's an example for you. All right. Okay, so how are we going to test this? We're going to rely on some basic things from the literature. So the first thing that's kind of known is that the transitory component of the SDF can be proxied by the return on a very long-term discount bond. All right. Technically, infinite maturity, which we're not going to have that, but we're going to try to take as long as possible. Roughly, the idea for why this is, in case you're curious, is that you think of solving like a model of the yield curve. What's going to happen is you're typically going to get the bond price as a function of the stationary state vector in the economy. And you think of what's the holding period return. It's like that function divided by itself between two periods for a very long-term bond. Okay, so it's the same function, and that's exactly a ratio of the same function, two different state vectors. That's the transitory component. Okay. On the other hand, it's well known that you can basically think about the SDF as the inverse of the growth optimal portfolio. So the return that's sort of the best over the long run. Okay. So that's the other thing. Now, if you just look at that, the SDF is this growth optimal, the long-term bond is the transitory. So the difference is going to be basically this permanent. All right. That's what we're going to use. Now, the whole name of the game is to try to make sure we have a good proxy for this. And the one that's kind of hard, if you think about asset pricing and all the failures that they've had over the years, is what's the R star that we're going to use, the growth optimal portfolio. So what we're going to do is look at first just the stock market, and then we're going to do a bunch of robustness around that. And I'm going to try to convince you that it doesn't really matter how you look at it in this case. Now, what I want to emphasize here is that when we look at this sort of excess return in logs, the test is that that thing should be zero on monetary announcements. Monetary policy should not move H. That means this return should be zero. Now, of course, the proxy is not going to be perfect, but we're going to see that the deviations from zero are kind of big, and I'll show you a way to do statistics for that too. Another thing that just, as you're thinking, is that there's this idea that the Fed can impact long-term yields, maybe longer than you would have thought. I want you to recognize that that's sort of like abstracted from in some sense here because we're taking out this long-term bond return. All right, so in some sense, this is something about other components of risk in excess of that long-term bond. So here is what happens if you take the S&P 500 minus a long-term bond future in 30-minute windows around the monetary announcement, and you piece together an accumulative return. So this is a high-frequency return, just pieced together over time. All right, so what you see is this is supposed to be flat at zero if the proxies were good and long-run neutrality holds, and it's clearly not flat at zero. Now, of course, like I said, it's never going to be perfect. What I think is compelling is that it's kind of systematic and it has an interesting pattern. In particular, what I want you to focus on is the part around the financial crisis where there's a big decline and the recovery afterwards. All right, through the lens of how this affects H, what that would say is that there's a big increase in marginal utility through the permanent component around the end, sort of financial crisis, and then a recovery as all these unconventional policies are coming in play and as we're starting to understand them. So it's going to turn out that's a very robust part of the pattern, regardless of how you do it. How do you do statistics for this? So you can just look at it, and I said that's one way if you just like pictures. But what you might want to say is that if the return is supposed to be zero in excess, if you regress one of the returns on the other return, you should find a perfect R squared and a beta of 1, basically. All right, and that allows you to then do statistics, and you see it's pretty far from that. Within the little window around the monetary announcement, which is in the middle one here, it is true that the beta is higher than it is outside of the window, but it's very far from 1, and the R squared is still very far from 100%. So there seems to be a lot of room for long-run neutrality violation. So okay, that's sort of the benchmark. Now, one thing that we could do is try all kind of different portfolios that proxy for this growth optimal, and that's going to be like infeasible. And what we did instead is went all the way to the other extreme and took sort of a state-of-the-art version that combines various anomalies and market timing strategies to the best of their ability using sort of a machine learning approach. And this portfolio is meaningfully different than the S&P 500. It performs way better. So if you look at the Sharpe ratio is like more than 3 times higher. And it's not that correlated either with the S&P 500. So what we're going to look at here is something that isn't mechanically going to be the same. All right. Nevertheless, if you look in this high frequency window, just like before, I told you the pattern looks kind of the same. There's some differences, but the robust part is the one I emphasized, that around the financial crisis and then the unconventional ZLB period afterwards, this recovery. Okay, you do the same statistics again as before, regress one of the returns on the other. The betas are even farther from 1 now. They're basically 0. The R squareds are all basically 0. Okay. Okay, last thing here is that I like, this was a suggestion from a discussant at one point. I think this is a really cool idea. Imagine we're never going to have the right proxies, but we know, or we think, that the unobserved returns that we want have the same sign as the proxies that we have. What that means is that the signs of our proxies should be the same under long-run neutrality. You could just test that, sort of run a regression of the sign of one on the sign of the other. What you see when you do that is that the betas are super far from 1 again, and the R squareds are tiny. Okay, so there's kind of no sense. Basically, stocks and bonds move frequently in opposite directions around these monetary announcements. Okay. All right. So like I said, just to summarize, it seems like regardless of how you do it, you get this pattern that long-run neutrality isn't holding. It seems like a big part of that is this period 2009 to 2015, especially, and I find that pattern interesting, the direction that it moves. Sort of jives with how I think about what happened in that period. One thing I mentioned, we have a real SDF. We've also looked at inflation expectations, and adding that in doesn't change any conclusion. So I don't think that's a part of what's going on. So why should you care about this? So this is kind of the thing. I asked those 2 questions at the beginning. Here's kind of the answer to those 2 questions. All right, so here we go. So here's a model. This is like as general as I could think of, and it's basically building a little bit on top of this Hansen-Shankman framework that they had. It's basically a statistical model, so there's sort of nothing really going on, but I just want to say that once you've solved your model, a lot of times it'll fit into this, okay? This is pretty general. Some kind of state vector that's evolving. I just want to point out that there's like monetary shocks, which are these Poisson sort of jump shocks, and there's this everyday Brownian non-monetary shocks, so that's there. And then there's a stochastic discount factor, which can respond to all type of shocks, including the monetary shocks, all right? So that's there, and the prices of risk can be functions of the state vector as well. And then I'm just gonna assume this is so that we can sort of do things theoretically, that the drifts are all affine, all right, in the states. Okay, so the first thing is this question of bonds and stocks being connected or disconnected on monetary announcements. And there's kind of like a little bit of a, not debate, but 2 perspectives in the literature that I find compelling. So one, this Nagel and Shu paper that argues that if you look at stocks and long-term bonds projected onto the short rate, they seem to respond similarly in magnitude, okay? Another one, Bowman Kroner, the discussant today, talking about how in general, not projecting on the short rate, you find a big disconnect. So there's a lot of movement in stocks that's not predicted by what happens in bonds. Okay, so we're gonna explain this now. So the assumption is that suppose you're in like the standard case like affine term structure models would have and various other things, that you could take the yield curve and infer the underlying stationary state vector. All right. Imagine you could do that. Then what's true is that you can, the yield curve will not explain this growth optimal portfolio only if long run neutrality fails. All right. So it's like a necessary condition for this disconnect. On top of that, an extra thing I want to point out that we're going to need is that there's more shocks than state variables. So there's sort of like a sense in which X does not span all the possible shocks. You also need that because obviously if X spans all the possible shocks, then it spans the shock to equity as well. Okay. So how do you see this? Very easy. Just look at the growth optimal portfolio, regress it on sort of the yield curve and the yield curve changes. That's equivalent to regressing on X and X changes. Okay. If you look at what the growth optimal portfolio is, the inverse of the SDF, there's the transitory piece and the permanent piece. And basically the question is, how do they move on monetary announcements? Under long run neutrality, what happens is the permanent piece goes away. Okay, so you're left with this thing which is a function of X, and it fits exactly into the regression with zero residual. That's the point. So you can do this also quantitatively. So we did like a very simple model, like a discrete time affine term structure type model with 2 states and 3 shocks. And what we sort of did is this Nagel-Shoe exercise in the Bowman-Kroner, and just in the interest of time, just going to say it's possible to get those in the range of what they found empirically. So in the sense that their equities and bonds move similarly in response to short rate shocks, that's on the left here. The R squared is very low when you do that, by the way, telling you that the short rate is very little of the news that happens in those windows. On the other hand, the Bowman-Kroner result is also there, that the R squared of regressing equities on the entire yield curve in general is low. All right, so it's in the range that they have. Okay, so last thing here is that I told you, how can you identify these type of shocks? And the approach we're going to take here is imagine you just have a generic forecast revision that you're looking to identify. So something like this for the state vector. Imagine you take a reduced form approach, which is I just go to the market, I try to use market prices to learn this thing. Like what would happen if I did that? All right. So the theorem is basically imagine first that monetary policy doesn't affect the sort of everyday volatility, the non-monetary volatility. Then it turns out that long run neutrality allows you to identify this just by looking at asset markets and imposing no structure. Okay. And on the other hand, if long run neutrality fails, you can't do that generically. All right, so it's kind of the critical condition. How do you see this? Maybe like 1 minute left, something like that. 3, okay, great. All right, so I'm gonna prove this to you in 2 minutes. So how does this work? You know, generally speaking, that when I look at asset markets, I can identify risk neutral expectations. There's a better thing you can do than that actually, which is expectations that are only risk neutralized with respect to permanent risk. So it's sort of like taking out fewer of the stuff, all right? That's what this thing is here, this E hat, all right, this expectation. Now I can learn that from the market. It's just a price of some claim. And that's what's shown here. Turns out that that's a bad proxy for expectations. And the reason is that we know from things like Alvarez and Yerman that this permanent component of the pricing kernel is very prominent, all right? It's very volatile. So the E hat and the E are gonna be very different from each other. Luckily, we don't care about that. We care about forecast revisions, which is the first difference in this thing. And so the question is, if I looked at this first difference, all right, is it going to be the same as what the market says, the E hat first difference? All right. Now, how do you think about forecast? Well, in our model, I told you already that there's sort of like this affine structure to it. So what matters is the drift of the state vector. All right? And the drift of the state vector in sort of investors' minds is the first line, and the second line is what the market would say. The market's going to have this extra risk correction, okay, here, which is a correction for permanent risks and the volatility of those risks. All right, that's the multiplication there. Now it turns out, so under the condition that monetary policy doesn't affect those everyday risks and long run neutrality holds, those are both functions only of states that monetary policy doesn't affect. They're basically exogenous. So when you take the first difference of these drifts, they're the same. Okay, so the forecast revisions are going to be the same. That's basically the proof. Now, in the last like 30 seconds, same model as before that I didn't show you, so you got to trust me on this, but the 2 states, 3 shock model that's calibrated, you could do this exercise for a particular shock to see how bad it is, basically. So you go to the market, you learn this. This is just from prices, okay? So you would see like there's sort of a tiny shock to the future interest rates, but there's a big shock to future risk price today and in the future. That's what the market's saying. What actually happened in this world? Well, it's substantially less. And if it was in a financial crisis, which I'm defining as elevated risk prices, the bias is even more significant. All right, and sort of the general idea is that we're learning the market thing from a risk neutralized measure, which tends to be pessimistic. So before the monetary announcement, it was pessimistic. Then there's this easing shock, and it looks like a giant shock relative to the previous pessimism. What actually happened is a little bit of shock in a very sensitive asset market. All right, so it moved prices a lot, but it was actually a small intervention directly on behalf of policy. All right, so we need to take that into account when we evaluate this. All right, so I'm done. So long run neutrality, I think, is an interesting centerpiece. We show that it's violated and it's consistent with models of Fed-driven uncertainty, et cetera. So thank you so much.
The discussant is Christoph Bohn.
Great. Thank you very much for asking me to discuss this paper. It's actually a very exciting paper. So here is a sketch of the argument. They introduced this novel concept of long-run asset pricing neutrality. They then propose a test of this condition and reject it in the data, and then they think about the implications, which are, and this is directly from the paper, rejects most macro models, it rationalizes certain empirical patterns, and lastly, if you don't have long-run asset pricing neutrality, then most of our approaches to identify monetary policy shocks are incorrect. So that's the quick summary. I have to confess, I was initially quite skeptical to this concept of long-run asset pricing neutrality, and the paper convinced me that it's actually key. So I think this is very useful. And another thing that's very useful about the paper is that there are tons of models in them. There's probably a dozen or so models in them, some in the text, some in the background, obviously not fully specified. But for someone who doesn't use these a lot, it's been sort of super helpful to see this all written down. So let me very briefly go to this concept of long-run asset pricing neutrality. Payman summarized it really well, so I'll be quick. It's all about this H term, which is the permanent component of the stochastic discount factor. Why is it permanent? Because it's a martingale, so there'll be later on monetary policy will actually affect this within this window, but that change is expected to persist. Okay, so that's the sense in which it's the permanent component of the stochastic discount factor. For a while, I was a little confused about what the relationship between macro long-run neutrality is and asset pricing long-run neutrality. So what is it? Does one imply the other? Are they potentially equivalent? And the paper is not sort of, doesn't fully show this in general, but turns out I wrote down the same table as you did. It turns out that in most of our models that we typically use, both hold simultaneously. So as Payman said, in the standard New Keynesian model with CRA utility, you have both. That's because this H term is just a constant, no shock affects it. And richer New Keynesian models, that's also the case, but there's an important counterexample. This is with Epstein-Zinn and growth and volatility shocks, where H is not a constant. You can set it up in a way that there's no long-run effect on consumption. So through that simple model, there's the macro long-run neutrality, but you can get a violation of asset pricing long-run neutrality. Okay, so that's important because this means that macro long-run neutrality does not generally imply asset pricing long-run neutrality. Okay, so if we reject asset pricing long-run neutrality, we do not reject macro neutrality. Okay, so for me, this was a very important thing to understand. So instead, what is it about? The violation of asset pricing long-run neutrality has other consequences, points towards certain preferences, shocks, and has these other implications that I'll discuss. Briefly about the test. So the growth optimal portfolio return captures both the transitory and the permanent component of the stochastic discount factor. The long-term bond return, only the transitory component. You take the difference, and what you end up with is the permanent component of the stochastic discount factor. Now, long-run asset pricing neutrality requires that this is not affected by monetary policy, but in fact, we'll see a violation. So here are some auxiliary assumptions that this test makes, and one of which is mentioned in the paper, and Payman mentioned it in the presentation. You need good proxies for this growth optimal portfolio. as well as the long-term bond. They use as the baseline the S&P 500 and the 30-year T-bond. They have other robustness checks. I could criticize it. It turns out I don't have a better suggestion, so I'll not do that. Instead, I want to highlight another auxiliary assumption which is maintained for this test but not discussed, and that is that there are no non-monetary news within these narrow event windows. So this is a standard assumption that we make for yields and bond returns. It's somewhat less plausible for equities, right? Equities are very volatile. There's always news driving them. And you can also see from data that's reported in the paper that this is not going to exactly hold. And so, for instance, the paper reports the return volatility of this portfolio along the S&P 500, short the T-bond. That volatility is about 60 basis points in this 15-minute window around the FOMC announcement. It is still almost 30 basis points on non-FOMC days, right? And so since there's presumably almost no monetary news within 30-minute windows on non-FOMC days, these 27 basis points suggest that there are certainly other drivers that are moving these returns around. I've checked with my own data. It's not lining up exactly with these specific windows. Most of this is going to come from equities, right? Because equities are more volatile than these bond returns. So hold that thought. I'll come back to it in a minute. So now, what about the test? So this is the visual. Payman showed it. It's clearly not zero. Right. So in that sense, it's a sort of a slam dunk rejection of the hypothesis. But when I looked at it, there is sort of this little wrinkle. When I looked at it, the most striking episode actually looked to me like the episode from 2001 to 2004. And it's not a big deal, but it's a little bit inconsistent with this narrative that, for instance, long-term large-scale asset purchases could potentially drive these violations. It turns out with the other proxies, this was not as prominent, but for the S&P 500, it was. So here's the test. They regress the T-bond return on the S&P 500 return under long-run neutrality and these auxiliary assumptions. The beta should be 1 and the R squared as well. As you saw, that's soundly rejected in the data. The beta hat is about 0.3. The R squared is less than 0.2. So very firmly rejected. Here's my first comment. So now let's go back to this case of reintroducing non-monetary news within this event window. Okay, and so in particular, let's imagine we observe the total S&P 500 return, and let's decompose this here into a part that's driven by monetary policy news and a part that's driven by non-monetary news. I choose very specific notation here. You'll see in a minute why. Let's take that observed S&P 500 return and plug it back into the regression. And let's assume, which is plausible, that non-monetary policy news is orthogonal to monetary policy news. Then you see that, in fact, this non-monetary news acts like classical measurement error in the regression. And so it could, in principle, explain why we have these beta hat far below 1 and the R squared as well. Now, is that sort of fatal? No, it turns out it's not. So you can use an alternative test in which you just switch around what's on the left-hand side and what's on the right-hand side. So now I want to have on the left-hand side the S&P 500 return. The T-bond return, for which we have less non-monetary news, is now on the right-hand side. The prediction now is that this mu is still 1. The R squared, there's no prediction for that anymore. And effectively, what this version of the test does is it relaxes one assumption, which is that we have no non-monetary news for equities. But we can allow for that as long as it's orthogonal to this T-bond return. So Anna shared the data with me, so I was able to implement this. Does it change things? A little bit. So for the 30-year T-bond on the right-hand side, it looks similar. And the coefficient estimate is still about 0.3. If you use the 10-year bond, then it does go up. Okay, but nonetheless, it's still a rejection of the hypothesis. I've done it for all the other proxies. It looks similar. So I concluded from that despite sort of what I think is a better version of the test, it's still a strong rejection of this asset pricing long-run neutrality. Okay, so now we've rejected it. What are the implications? So you should think of it as monetary policy affecting the permanent component of the stochastic discount factor. Here are the 3 consequences that the paper emphasizes. Most macro models are wrong, so that's bad news. Then this can explain certain empirical patterns. In particular, these are facts that Niklas Kroner and I have established. And lastly, and this is from the abstract, monetary shocks recovered from asset prices will necessarily be polluted by risk premium effects. Okay, so those are the consequences. It looks, pretty dire. But in fact, I think there's sort of a much more optimistic message in this paper, because it also provides sort of directions in which to go to fix these things. So, going back to the macro models, use Epstein's include these shocks, and all you have to figure out is how monetary policy shocks drive these reduced farm growth and volatility shocks. And then we are sort of halfway, or we're on track to be back. I want to argue that, in fact, the second point is very important, and I'm going to come back to that in a second. And lastly, I want to discuss this identification result, which is perhaps the most important implication of the paper. Okay. So very briefly, what did Niklas and I show? So we showed that there exists a non-yield shock. What is that? Monetary policy affects asset prices through channels that are not spanned by the yield curve. So you can show this with statistical tests. It shows up in excess variances, changes in covariances, etc. So you can statistically detect that. What is this? So that's much harder to say. It just means that monetary policy is higher dimensional than we thought, and so high dimensional that you cannot capture it with the yield curve. You can use that variation and construct a shock. We did that. It doesn't have a very clear interpretation, except that you can say it comes from monetary policy. And then you can take that shock and look what it does. And it turns out to have these massive effects on stock prices, exchange rates, commodity prices, and so forth. So it cannot be ignored on economic grounds, but it's perhaps not quantitatively relevant. It is. And lastly, we showed that if you look at conventionally used identification schemes, then the existence of this non-yield shock typically invalidates these. If these identification schemes are exclusively based on yields. It's very simple. You have basically more unobservables than you have observables, and you can't really, there's no identification scheme. However, you can use this non-yield shock to construct new identification schemes. Now, let's merge these insights with those by Anna and Payman. And I realized that, in fact, these LRN violations and the existence of the non-yield shock are very closely related. In particular, they're proposition 1 in this model that Payman briefly flashed. If LRN holds, then there's no non-yield shock. Okay, that also means that if there is a non-yield shock, then LRN is going to fail. So now let's put this together with what Niklas and I found. It means that the non-yield shock, in fact, captures these permanent effects on the stochastic discount factor. And that helps a lot to understand why the non-yield shock had these very large effects on various asset prices. So here are these, is a summary of that. Take a 1 standard deviation non-yield shock. These occur frequently. And look at the effect on global stock prices. So this is a pooled effect on various stock prices. It is about a 0.5% effect. So these occur all the time, and they have very large effects. Contrast this to other monetary policy shocks from the literature. They have much smaller effects. It's very similar for exchange rates and commodity prices. And so now that I know that this non-yield shock, which embarrassingly I didn't know, affects this permanent component of the stochastic discount factor, I understand a lot better of why that is going on. And there's another corollary from that, which is that if you extract shocks from the yield curve, you will miss the effects of monetary policy that are probably the most important ones for various asset prices, stock prices, exchange rates, commodity prices, and so forth. So particularly for this crowd, I think this means we should think a lot more about this, these LRN violations or a non-yield shock. Last point. So the model is complicated or sort of general, but it's also sort of, very inclusive of many features. So what I'm trying to summarize this here in sort of a more abstract fashion. So imagine you have a general identification problem. You have shock Z observed with O, and you have a model that maps the Z shocks into O, which are the observables. What is identification? I need to know F, and I need to have F be invertible so that I can express the shocks in terms of these observables, and I need to know the function. Okay, when can identification fail? It fails if you have too few observables relative to the number of shocks, if you don't know F, or if F is not invertible. So those are the 3 possibilities that can challenge it. identification. If you have no model at all, that would mean that you have no F. Okay, so now let's go back to Anna and Payman's paper. They have this setting which is very ambitious, very general. They think about identification problems that are very complicated. So for instance, how can monetary policy affect certain future outcomes only in certain states of the world? Those are the types of identification problems that they want to solve. So very complicated. Now so that's proposition 3, under long run neutrality, you can identify these shocks. The paper assumes throughout that you have enough observables. In practice, of course, that may not be the case, but supposing that would be the case. Without long run neutrality, you generally do not have identification. Okay, and so here I'm a little less convinced in the way sort of the results are interpreted. The results are, obviously correct. But the framework is general and identification problems are specific. And if you are specific, you have way more structure that you can exploit than you guys impose in the paper. And I was in the process of trying to sort of show a case where you can get identification again. And then Payman sends me an updated version of the paper, which kind of rules out that case. So, I think the tension is with this general versus specific. In this general framework that they can show, you don't have enough structure to identify these shocks, but that's not a proof that without, with imposing more structure, adding more observables, you can regain identification. In the paper, the way they have it, and I think Payman discussed this very nicely, the issue is that this F is time varying and unknown to the econometrician, and these shocks sort of can, without LRN, the shocks are going to shift beliefs which the econometrician doesn't observe, which is this F shifting around or not being known. Okay, so I think ultimately the challenge going forward is to impose more structure without LRN to recover monetary policy shocks. Let me just conclude. There are 2 features of this paper which I was very happy to see, that monetary policy is very high dimensional and the yield curve doesn't span those. That's adopted throughout the paper, and I think we make a lot of progress by just accepting that. And then a lot of things follow from that. Identification has become much harder, but not impossible. The paper suggests a little bit that looking at asset prices is the wrong way to go because they are subject to these these updates in risk premia. But the truth is, ultimately, monetary policy is very complex whether you use asset prices or not. So not using asset prices is not going to solve this issue. And so ultimately, the challenge is, how can we come back to identification if we have a failure of LRN? Nicholas and my conclusion was we need to add more observables. This is sort of not fully spelled out in the paper, and sort of it would be nice, even though the paper does a lot already, to at least provide pointers in which direction to go. So ultimately, I found this formalization super useful. I learned a lot, including about my own research, and I found it very complimentary. So thank you very much.
All right, so now we can open to questions. Please get close to a microphone there, and you can state your name and you want to go that.
Great paper, super clear. I have a question. You have tested these classic models, but then there are also newer generation models, which Payman also works on, these intermediary-based models. In those models, you can have a feature that you have money shocks that affect intermediary wealth, which directly affects the risk premium, including the long-term asset prices. So I wonder if that's a better fit to the empirical facts. Now, I know that in those models, you also have your long-run steady state, not affected by monetary policy. But what I think for empirically that matters is how persistent it is. You can't find infinite horizon bond. You have a 30-year bond, so that's still not infinite horizon. So if you have a model that is persistent enough, like intermediary capital doesn't recover fast enough, that might be very close to what you have. And then also a related comment is the convenience demand and demand-based asset pricing, where you don't necessarily have SDF commonly connected, but demand matters, like convenience demand. The money policy shock that changed the convenience demand, that people shuffle the portfolio between equity and bond, would that be a fit? And how does that relate to the empirical fact? Thanks.
Sure.
Yes, so two comments. I liked Chris's suggestion of flipping the right-hand side and left-hand side variable because of the noise in the regular period. But it seems to me also that this might be a very good candidate for using identification by heteroscedasticity, because both of those might have a noise in other periods, and that would take care of both of those, I think. But my main comment was that I liked the suggestion or the thought that this might have to do with Fed information effects. So the idea that there's news about the state of the economy that is revealed when the Fed makes monetary announcements. And in that context, to me, that seemed to be a great explanation, but that would mean that some of the conclusions of the paper were a bit overstated. I think that would mean that it's not true that this rejects all macro models. And I've never really fully known whether I understand how finance uses the term risk premia, but I think that would also mean that this was not really about risk premia.
Any question?
Harjo Bammer Imperial. So I have a question which I think I asked you before. So this R, you look at R star minus R infinity, right? And you say, well, that's not zero, so LRN is violated. But don't you have to show it some martingale before you can even begin to use your argument? And it doesn't look like a martingale to me, because it does this. So that would, to me, suggest that you can't even begin to use the machinery to make your argument. You have to show it's a martingale first. Is that right?
Yeah, great paper, great presentation. And I think in general, I really like the direction that you have gone and others have gone to put bonds and stocks together around these dates, because there's just a lot. I think I completely agree. There's a lot more information in this stuff together. I was just hoping you could clarify because, or just speculate a little bit more about the resolutions, because as we know, risk premia always are a combination of price of risk and quantity of risk. You have emphasized news about the quantity of risk, monetary policy uncertainty as a potential resolution, but monetary policy calming markets can also be something like price of risk, risk aversion, risk bearing capacity. How would you think about that separately? And quantity of risk, can also be uncertainty about monetary residuals, so monetary policy doing random things. Or it could be that we're learning about the monetary reaction function, which is covariance between interest rates and the economy, which is a different aspect of the quantity of risk. How would you think about your results in relation to that? Does it, that would just be kind of interesting.
Why don't you take these 4 questions and then we raise a second round?
Yeah, thanks for those questions. So this question about the intermediary-based asset pricing, that's, I think, fine. The thing I showed in the table is that the standard way we write those models down is that the wealth distribution between intermediaries and everyone else is a stationary variable. But Wenhao is correct in the sense that if monetary policy affects that thing for like 30 years, then based on our proxies, it's going to show up as kind of a permanent component. So that is correct. Now, it's a bit of a question. I mean, in the models that can happen sometimes, but I find that to be like an unrealistic feature of the models. So I agree with you. Ultimately, like any of these state variables that's very, very persistent in response to a shock by monetary policy, then that's gonna be hard to separate based on our proxies. But just to be clear, in the way we normally write the models, this is a stationary variable. It's not the case that it's just a martingale moving around their wealth, right? Okay, so there was a question also about the demand-based asset pricing and convenience yields. I have to say, it's a bit hard to say what would happen in that world. So we assume no arbitrage, existence of SDF, all these kind of things. And in this sort of like better world, the world that is set up for us to succeed, it's still, you fail. If you have like more degrees of freedom, stock market and bond markets not integrated, they can move kind of in arbitrary ways. I don't see how that would make things better. It would just make things worse, right? Did you want to?
So to John's question, If the Fed is able to move somehow the R star and long-run growth expectations, and that comes out at the time of the announcement, that would fall into the category of these violations to the extent that long-run growth expectation shocks are priced. That would be the Epstein's example.
Yeah, so, and we don't, I mean, we have nothing really to say about we can't really decompose information effects from direct policy impact. And so that's, if you think the information effect is small, then the conclusions of the paper, the way I stated them, would be, but you're right that if it's all information effects, you know, then it's not the case that monetary policy is particularly powerful. It affects uncertainty. All of those statements would be wrong. So in that sense, there's like a separate line of literature needed that's not based on, it's not our methodology to separate that, but to separate the information effect from the direct causal effect, it's very important to sort that out, I think.
Yeah.
Should I say the martingale thing? Yeah, martingale, real quick. Sorry, I realized I didn't answer this. So in principle, under rational expectations, H should be a martingale. Now, remember, I do everything under the investor belief. So this is a martingale under the investor belief. And we wanted to allow the possibility that investors have beliefs that's not fully rational. In that case, you can't test that assumption directly in the data. Now, at the same time, even if there was rationality, it's very difficult to reject something as a martingale in this type of sample. So I don't even know, but we can look into that. That's something we can look into. But just theoretically speaking, it's not necessarily the case, right?
And to add to this U-shaped plot, it's very hard to infer whether or not this is mean reversion. So what we will look at is the effect of this on asset prices. If the effect stays, then it tells you something about the permanent effect. And then finally, Caroline, sorry? And the last point was by Caroline about the price versus quantity of risk. So we don't separate those also in our measures. Both of these things are there. You can certainly write down models and try at identification where you sort of separate the two. But in general, it is probably quite hard to do empirically. My sense would be that the price of risk is moving around a lot. I don't know about the quantity of risk for macro.
I'm really sorry. One more thing to add, just to be super clear, because the discussant raised this point too. The resolution, like what can you do? One thing is, it's not the case to throw out the asset prices, like which was one of the, you want to keep the asset price very informative. The point is that you cannot use them in a purely reduced form way. You have to use the model structure somehow. So the suggestion is like keep the asset prices, but have a model, use it together. And we actually show it in an appendix that if you rely on the model structure, you can say a lot more. And so, yeah.
All right, so let's raise some other questions. Amy.
Great paper and discussion and conversation. I wanted to come back to this identification question and just point out that the bar about for identification here is very high, in the sense that the traditional question about identification of monetary policy shocks was whether the things that we saw happening in the economy were influenced at all by what the Fed did. That was the traditional thing. Like maybe we see the interest rate move, but maybe that has nothing to do with the Fed. But here, actually, if I understand correctly, the bar that you're talking about for identification is actually about channels. So, you know, does the Fed influence the economy through, you know, one mechanism versus another? And for example, in, you know, saying that identification has become more complicated, it's about, you know, is it an information effect? You know, is it like interest rates, forward guidance? Is it, you know, some effect on these long run factors? And so I just wanted to kind of underscore the fact that the traditional debate was just about whether there was any influence of the Fed, you know, on the economy, period. And this seems to be all about, you know, through what channels. And so, you know, even if one has to kind of step back from the claim that you know what the channel is, you know, it seems like you're providing a lot of interesting evidence on that front. You know, it's important to kind of not lose sight of the idea that, you know, you're still benefiting from identification as pertains to whether it's all reverse causality, which I think, you know, you're still not saying it's all reverse causality. You're saying something coming from the Fed, just, you know, what it is a little unclear.
I didn't fully understand your answer to Wenho's question about convenience demand. So I can imagine a model in which there's an SDF that prices equities and one that prices, say, treasury bonds, but in the treasury bond pricing function, there's another term, which is that treasury bonds give you a convenient service, the same SDF, but I think you break the equations you're writing down. So that does feel like one rationalization of your effects, and it certainly is consistent with the stress you're placing on the QE period, where changing around bond supplies and reserves presumably move some of these convenience factors and could again explain some of the findings you have.
Tell me if this is correct. So the way, this seems to me from the discussion to be three ways that you would get this. One is that there's macro information thing, and macro information that comes out, and that's just a problem during the 15-minute window. The second one is that, is what others saying, that during that 15-minute window, the bond market and the stock market or whatever are not perfectly integrated, so you can't get that information out of bond yields. And then the version with the risk pricing, it's a bit of a theoretical thing, but it has come out before. I think what you're saying is under the risk-adjusted view of the world, there's something that's, got a persistence of 1. And you see that, for example, in looking at like options or volatility, is that things like expected volatility move out for 30 years. They move out quite a bit. You can trust those prices. And that looks, and that's not that hard to get under risk adjustment. It always makes the persistence higher. And so you act like things are persistent, for a very long time. They're not actually like that, but they risk adjusted are like that. It's still a bit of a theoretical curiosity in the sense if it's too high, things go like berserk and you get prices that are, not stationary. But those seem to be, my money would be a little bit on this in the 15-minute window. It seems like a pretty strong assumption to assume that these things are, perfectly integrated. But maybe I'm not saying that right, so you can let us know.
Very nicely done. So 20 years ago, there was a literature on shifting endpoint VARs and the world not returning to where it began from, right? And then led to learning about the central bank's preferences, what the numerical definition of price stability is, which are things that would generate at least some of your results. And one of the things I think you could do, which would be informative, is to do this exercise for not monetary policy releases, but for other data releases, which is going to tell you, is it just monetary policy that triggers this reaction? Or is it that whenever I learn something about the state today, I revise my beliefs about forever? And that would help you separate between some of these alternatives.
Any other question? Yeah, Moritz.
Thanks a lot. Very interesting paper. I still don't fully understand it. But seeing the connection to Böhm and Kroner made me wonder about how you're thinking about state dependence. So these intermediary models, they have the state dependence where monetary policy effects has different effects in different states of the world, like low intermediary wealth or high intermediary wealth. Should that now affect your R star measure maybe in different states of the world? And would that affect your identification or not at all?
One more question, Jen.
It's very inspiring discussions. So I was just check what is definition of a monetary policy shock, and this is all discussions based on traditional macro. But as a previous Fed employee, I think in this modern central banking, they're thinking more. It's not just something orthogonal to fundamental. They actively include communication and shaping the expectation and affecting investors' belief as part of effective monetary policy tools. So I wonder in today, how this monetary policy shock should be considered. Isn't that belief revision should be considered part of this monetary policy instead of just purely on something too fundamental? Thank you.
So I will start with Emmy's question. So it is true there is an entire bundle of news coming out at the Fed announcement. And we originally started with thinking about short rate shocks. Now we are gradually expanding the set of what the Fed can do to distributions as opposed to just moving the short rate. So we have this broader view of monetary policy shocks. Now, where the separation or where the question of what is being moved matters is you want to draw an impulse response function using a particular identified shock. And we've been struggling with understanding, for example, why a path shock, as identified by Rifat and co-authors and Eric, moves the macro outcomes, move equities, move bonds. Well, it was hard because this shock is a bundle and it can have different structural effects depending which component in the bundle is moving around. So we want to unbundle essentially to draw structural impulse responses. And what Peimon has been talking about is this commingling of different things in what we call a structural shock. And then I will go maybe to Jenny's question about how the Fed thinks about monetary shocks, which is very related to Emi's question. And for sure, the examples of shocks that we entertain here are movements in expectations over and above any movements in actions, expectations of the short rate, but also movements in the entire distribution. So this would be uncertainty shocks, some skewness, and these can certainly be affected by how the Fed communicates. So these higher order moments of the distributions are primarily then driven by communication. And we want to entertain these shocks as relevant for macro and asset price responses.
Just because it's very fast, I can answer two of the questions with the answer yes, which is the Arvin's question and your question. So the 3 points you were saying, I mean, yeah, if the two markets are not integrated, that would be another explanation. But so yes.
So to Rafat, for sure, we've been actually thinking about looking at other macro announcements and whether or not long-run neutrality is violated. Presumably fiscal stuff and so on are, oh, we are out of time.
No,
Yeah.
you have one.
Okay. So that's a good suggestion. And for Itamar, there is direct evidence that the Fed is also moving variance risk premia, and that would be also related to kind of models that Peimon has been showing, where you have this continuation utility in there, and this is the way to get movements in variance risk premia.
Yeah, so I'm really sorry, Morris. I didn't fully understand exactly what your question was about the wealth and the state dependence. But so if you take, I think you might be saying a version of an intermediary model that's different than the one I wrote. But let me just say what I know, which is that if it's the type of model that I put in my table, then what will happen is like the wealth component will show up in the long-term bond. That's the thing. So not in the R star, in other words. For it to show up in the R star, it has to be this like permanent component. And so that is subtle, right? It depends on how you write the model down, whether or not, for example, you get this sort of reduced form risk aversion shock, then that can do it. But in these sort of fully specified dynamic models where intermediary wealth is mean reverting, blah, blah, then it's not. So it's a little subtle, and I'm not sure if that's your question or not, but yeah, but I can talk afterwards.
All right. Okay. So let's continue our coffee. We'll reconvene 9:45. Thank you. Hey, you made it.
Yes. Both? That's right. Thank you. Thank you.
Oh, this happens. Yeah, I know what it is. You of course was sick for a while, so.
All right, so let's continue with the second paper. Zhu is going to present. So you have 20 minutes. Thank you.
Thank you, Guillermo. Arvin, Marcus, Amy, and John for including the paper. I'm Shulu from UW, and this is joint work with Shangwu from NYU. He's here too. The paper is titled Banking on Inattention and is about bank deposits. And why are we particularly interested in deposits? Well, to begin with, deposits are massive. They are the dominant component of broad monetary aggregates and also the primary source of funding for banks. By the end of last year, deposits accounted for more than 80% of total bank liabilities. And deposits are also economically important. From the influential work by Alexi here with Itman and Philip, we know that monetary transmission relies on this deposit channel, and recent work from Arvin and co-authors also highlight there is important role of deposits in financial stability. Now, despite the important roles of deposits in banking and in monetary economics, there are still quite a few basic puzzles about them that are puzzling, right? First, why do people leave trillions of dollars in this low-rate bank deposit account? And second, when the Fed hiked the policy rate, why do banks pass through very little to depositors? And finally, how does this massive deposit base affect banks' interest rate risk over the monetary cycle? Now, in the next 20 minutes, I'll show you banking on inattention offers one simple and coherent explanation to all these puzzles. And the starting point of this paper is very simple. Many of us do not frequently manage our deposits. And in the data, we show that depositors are inattentive in that they do not frequently manage deposits, and the same inattentive depositors are also less sensitive to monetary policy changes. Now, building on this empirical fact, we develop and test a new dynamic pricing model deposits around inattention and show that it generates interesting new aggregate implications, and while reconciling these puzzles. All right, I'll circle back to how I measure depositor inattention later. For now, let me show you one empirical result, that is banks price depositor inattention. You can see here sorting banks by how inattentive their depositors are. The banks with more inattentive depositors consistently pay lower rates compared to the banks with more attentive depositors. Okay, so the banks serving more inattentive depositors set lower deposit rate. In terms of the literature, we contribute to several strands of work that in particular, we incorporate this deposit behavior into bank deposit pricing. And we show that this simple mechanism with one single friction from the demand side can help us understand quite a few puzzles in this long-standing literature. Okay, so in particular, I'm going to start today with this new dynamic pricing model of deposits. And I show later how banks use this downward sloping demand that is modulated by inattention to price deposits, which is supported in the data, both at the depositor level, we validate the assumption that deposit demand is downward sloping, interacting with inattention. At the bank level, I test a cross-sectional prediction on both quantity and prices, and then finally using the cross-sectional estimate to calibrate the model and highlight a few aggregate dynamics. All right, starting with a simple model. So this is a baseline model with a minimal ingredient to just illustrate this mechanism. Time is continuous. There is one monopoly bank, and the bank prices deposit against its deposit demand that decays from M0, and the decay rate is governed by two forces. The first is this tau inattention, higher tau, more inattentive depositors, and then slower the decay. Okay. The second is this deposit spread between the policy rate and deposit rate. You can think about in the background, there is a money market fund that pays the competitive rate, which is money market rate, policy rate. And the higher the spread, the faster the decay here. And intuitively, from the bank's perspective, it is serving a continuum of depositors who on average would manage their account every tail period. Now, when the deposits start to manage the account, they withdraw P fraction of the deposits, and P is a convex function, so that the profit function is going to be concave. Now, in the simple model, when the policy rate is a constant, the bank set also a constant rate that is non-negative to maximize the bank value, which in the model is going to be the deposit franchise value. And the deposit franchise value is defined as this discounted sum of all the future deposit profits, which is profit margin times the deposit demand at the time, MT, discounted at policy rate rho. Now here, because the discounting is exponential and the decay is also exponential, we can rewrite this integral into these 3 terms. Okay, so in this fraction, there is profit margin against deposit rate and discount rate. Now, importantly, the bank is trading off in setting the deposit rate between the profit margin today and the decay rate, which governs how big the future deposit base is. Now, the higher the policy rate the higher the deposit rate, the lower the profit margin, but also a bigger deposit base in the future. So this is an intertemporal trade-off. Now, because the deposit rate only shows up in the deposit spread, we can rewrite this value function as a function of the deposit spread. So here, the bank is choosing the deposit spread X to maximize the deposit franchise value for convenience. All right, so solving this optimization, we have 2 cases. The first is when depositors are highly inattentive, that they never leave the bank in the limit, then the bank can pay the minimum possible rate, which is 0. Okay, they don't pass through anything to depositors, they don't pay anything, and this is a counter solution. The interesting case is when banks started to face relatively less inattentive depositors, then they started to pay a positive rate to actively balance this current profit margin against the future profits. Now, in this case, you can think about if the depositors become more attentive, the future deposit drops, and the bank started to pay them a slightly higher rate to rebalance between these 2 forces. That means deposit rate decreases with inattention, the spread increases with inattention. Now, holding this deposit rate holding the inattention constant, let's look at how policy rate affects this deposit rate. Okay, we show that the pass-through is incomplete through this model. The reason is because the policy rate rho not only enters this deposit spread through this profit margin and the decay rate, but also directly enters this value function as a discount rate. Now, when the Fed hikes the policy rate, it not only changes the price of the money market fund, but also changes how banks evaluate the future profits. The higher the discount rate, the more the bank discount the future, the more they want to keep for today's profit, they can let go of some of the future deposits. Okay, in other words, monetary policy hikes, the pass-through is going to be not 100% because now the bank cares about future less. All right, further, this discounting effect of monetary policy is going to be stronger with inattention. That is, we find that in the model, pass-through declines with inattention. In the limit, when depositors are sufficiently inattentive, the bank pass through 0 to depositors. All right, I'll circle back to empirically Tesla's predictions, but before that, just a word on deposit franchise value. This deposit franchise value increases with inattention. Okay, when tau is higher, the decay is slower and deposit franchise value increases. Okay, now with respect to the policy rate, there is a recent discussion in the literature that wonders whether deposits are a hedge for interest rate risk or not. Okay, so including some of the people in the audience. What we show in this paper is that when monetary policy rate is low, deposits are indeed a hedge for interest rate risk. But when policy rate becomes high enough, deposit franchise value started to decline in the policy rate. So the reason is at the low levels of the policy rate, here the bank optimally pays 0 rate and charges the full spread. Okay, so here the spread is just a policy rate, and the policy rate enters all 3 terms, the profit margin, the decay rate, and the discount rate. Now in this case, because P is a convex function, remember, and then when policy rate level is very low, you can think about it changes very little. The dominating effect comes from the profit margin. So higher policy rate makes the deposit franchise value increasing, okay? Now, when the policy rate keeps increasing, this is a moment when the bank optimally balances between this profit margin against the marginal decay. Now, in this case, because of the bank's endogenous optimization, this effective policy rate through this term deposit spread is offset in this optimization, okay? So when policy rate increases, the bank rebalance between this profit margin versus decay rate, offsetting these two forces, leaving the only force that's still at work is the discount rate of the monetary policy, okay? Here, higher policy rate, more discounting of the future, the present value of deposit goes down. That's why the sign flipped and deposits now add on to the interest rate risk. Okay, this is mathematically the envelope theorem. All right, so the takeaway here is deposit franchise value are not always a hedge, but when monetary policy is relatively in the easing period, you can see it's actually a good hedge for interest rate risk. All right, so now we're ready to take the model to the data. Now, I'm going to start with validating the core friction in this model, which is a downward sloping demand intermediated by inattention. And then I'll use this model to check the model's prediction in the cross-section of banks. That is, the banks with more inattentive depositors set lower rate, pass through less, and also quantity-wise has less rate-sensitive flows. And finally, using these cross-sectional estimates, we're going to calibrate the model and highlight a few interesting implications. All right, in terms of data, we have data layered at both depositor and bank level. At the bank level, we have this bank regulatory data, this tax filing, and a couple other standard data sets. At the depositor level, we can observe bank statement for about 26 million US depositors. Okay, so for these depositors, I have their transaction level information linked across financial institutions. For each transaction, you see the date, the amount, the location, if it's offline, and the tax description. This is very useful because then we can infer where do they work, what do they eat, I mean, which restaurant do they go to, etc. To understand the spending and their income. Now, how do we infer this model parameter tau, the frequency at which people manage their accounts? Well, this is observational data and people do not typically report to banks how frequently we manage deposits, nor, I mean, I don't even keep track of that. So how can we back out from these life decisions people are making their financial lives? Now, one observation come from Kahneman is very useful is we can characterize inattention through people's reaction to different types of tasks. The reactions to routine tasks are typically fast and automated, but reactions to these non-routine tasks require time and effort, which typically signals inattention. And putting this into banking context, so what I can look at is people's reaction to different sources of income. So some of the income, like my biweekly paycheck, or both known in advance the timing of arrival and the amount. But there is also tax refund. My accountant filed my tax refund. I know exactly how much I will get, but I don't know exactly the days left on my bank account. So it's very hard to automate ex ante. Now, if I'm fully attentive, continuously optimizing my bank account to the last penny, then you can imagine that I should react very similarly to these two different sources of income. The dollar coming into my account, I either consume it or move it to a high yield money market fund. But if people are inattentive, then we expect this unscheduled income stay longer in this bank account compared to the scheduled income. All right, this could be because the person is not noticing the amount has arrived, or because the person sees the amount, sees the income, but they don't have the time to think it through on what to do with it. Okay, so in the paper, we're going to focus on the banking implications and do not talk about the macro foundation. And here I'm plotting this impulse response, where we show that on average, across depositors, the unscheduled income, which on the top are the tax refund and fiscal checks, on average decays only half as fast as the scheduled income, such as salary and wages. Okay, this confirms that there is on average inattention in the deposit base. And now I'm going to run this impulse response at depositor level and compute the half-life, how long it takes for the income to decay to half of the initial income as a measure of this inattention. Now here I'm plotting this distribution of the half-life. You can see the half-life for the unscheduled income is much longer and much more dispersed, suggests there is a cross-sectional heterogeneity in inattention, okay, using this half-life measure. Now, so far we validated the model's one important friction, which is inattention. Does it matter for monetary policy? Well, it turns out if you plot this inattention against that around the FMC meetings, the most inattentive depositors withdraw only half as much as the most attentive depositors in the 2 weeks window around FMC announcement with a policy rate hike. This confirms the the model's assumption that is there is inattention, and inattention dampens people's response to monetary policy. Now, we now need to aggregate this depositor level inattention to bank level and then talk about how inattentive bank price deposits. There is a lot of aggregation details. I'm going to skip in the interest of time and directly jump into the result. Now, here on the left, I'm showing you that the banks with more inattentive depositors on average pays 10 basis points less for 1 standard deviation higher inattention. And on the right, they pass through about 3 basis points less. These are consistent with the model. On quantity, the model also predicts that higher inattention make the bank face less sensitive outflows, even though they charge a higher spread on average. Now, this is a classic issue that there is unexpected, unobserved demand shocks that both moves demand and prices. But in this framework, we have this new leave one out instrument. Let me just illustrate intuition here. So First National Bank serves Boston, has a lot of big depositors, and Bar Harbor in Maine, a very small market. Now, if First National Bank set deposit rate in this region, as previous paper highlighted in this uniform price setting, then the Bar Harbor depositors banking with First National Bank is facing this deposit weighted average inattention deposit rate. Okay, so because Bar Harbor has very few depositors, we can essentially drop this part and using Boston depositors inattention to instrument the deposit rate set by FNB. Indeed, we find this a good proxy for deposit rate, and in the cross-section for 1 standard deviation higher inattention, it reduces outflow by about 56 basis points, given 1% increase in the spread. All right, these are the cross-sectional evidence. I'm going to use the last few minutes to briefly talk about how we draw aggregate implications. First, on the calibration, we calibrated the model completely using this cross-sectional estimate from the bank level. That is how banks spread and spread beta and flow sensitivity vary with inattention. And we find even though this model is completely disciplined by this cross-sectional moment, it matches this untargeted aggregate data pretty well. Okay, so average decay and deposit spread and pass through all match the data moments. Now, one important new finding from this dynamic model is that the policy rate increases monetary pass-through, and this is consistent with more recent micro papers. All right, so far we talked about medium to long run outcome. In the last minute, let me just have a brief word on the short run adjustment. This model has really rich implications even in the short run. So in the short run, we know that in the past, people have noticed that while when the Fed hiked the policy rate, banks barely want to share the upside, but when the Fed cut the policy rate, everybody's cutting the rate immediately. Now, has been interpreted as a symmetry on the hikes and cuts. But in this paper, we show that there is a missing variable, that is a level of the policy rate. If you draw the line ranking them around the policy rate at the time when it started hike or cut, it looks relatively symmetric. Now, the reason is because when the hike starts, it typically at a low level of the policy rate, and a lot of banks are still optimally paying 0 rate, even though the policy has already hiked. Okay, for example, 25 basis point, banks are still optimally paying 0, so they don't need to adjust the policy rate. But if you compare them at the same policy rate level at the beginning, then the cut and hike, the apparent asymmetry is no longer there. All right. Okay, so this helps us to understand the asymmetry in the short-term adjustment. All right, the model is very simple and very easy. You can put it into a bigger model, but also generates rich implications. You can see if you want to find more interesting implications of the model, there is a lot more in the paper. Now, just to conclude, I'm running out of time. This paper shows, deposits may sit on banks' balance sheet, but ultimately its value and stability are influenced by people's behavior. Okay, so here in the paper, we have this one single friction. Depositors are inattentive. And we show this single friction, if we put this downward sloping inattentive demand into bank deposit pricing, it already helps us to understand quite a few puzzles in the literature and generate rich implications. I hope you learned something today, and we look forward to learning from discussion. Thank you.
Thank you. The discussion is Dean McGuane.
All right, great. So thanks very much for asking me to discuss this very interesting and policy relevant paper. I really enjoyed reading it, and I learned a lot. So the motivation for this is that when we look at the deposit rates that banks pay depositors, they're quite low relative to the policy rate. This is something that the literature has documented very well. This is a figure from the seminal paper by Dreschler et al. And basically what you see is, again, the rates are low, and that when the federal funds rate goes up, you basically don't have much pass through to deposit rates. Okay, and this is for all commercial banks. If you look for the more recent period, basically from 2015, and you look at just the largest commercial banks, what I've done here is split it out basically into checking and savings, and you see that basically the rate on checking accounts is just zero, completely insensitive to what the federal funds rate is doing. And there's maybe a little bit of pass through on savings rate, but again, very, very low. And so the literature has tried to understand, well, why might this be? Why do we see such low deposit rates, and why is there such little pass through? And one thing that people have said is, well, what banks might be doing is that they have this sticky depositor base, and they're basically going to say, well, I want to exploit my sticky depositor base, and I'm willing to basically keep rates low and maybe sacrifice acquiring some new customers so that I can exploit this sticky customer base. This is actually an old idea in product markets. It goes back to famous papers by Klemperer, but this has basically been out there as a possible explanation for why we see these features in deposit markets. The issue is that it's been really hard actually to document this on the micro level because, and that's for data reasons, that if we, for example, look at bank call reports or things like that, the issue is it's very difficult to track depositors between banks, right? So if I see a depositor at Bank of America, it's very difficult to then see that that depositor actually take their money and go to Chase. So it's difficult to really understand depositor behavior at the micro level. So what's really nice about this ambitious paper is that it provides a new measure of depositor inattention based on how quickly households are responding to these scheduled versus unscheduled income events. And then it's going to try and aggregate this up to the bank level and then basically understand how banks with more inattentive customers, how does that impact their pricing? And then it's going to also have a dynamic model that tries to help us understand some of these features. All right, so what I'm going to do with the time that I have, I want to just briefly kind of summarize the paper, and there's a lot there, and I think it's important to understand the mechanics of what's going on. And then I want to talk a little bit about the empirical strategy and some aspects of maybe what the model might be missing. Okay. So the data that the authors are bringing to bear is this very nice transaction level bank data, covers more than 26 million US depositors between the years of 2014 to 2022, and has daily account balances and transaction histories. And crucially for this paper, you can see income flows classified by source, including wages, Social Security, tax refunds, fiscal transfers, et cetera, and you can also track some of the consumption that they're doing as well. And they're going to combine this with some standard sources like IRS and census, FDIC summary of deposits, and call reports. Okay. All right. So what is this paper going to do? Well, again, what it's going to do, it wants to try and measure inattention at the household level. But again, it has to sort of get at this through a somewhat indirect way, because you can't, again, see depositors going across banks, right? You can't see them going from Bank of America to Chase. So what they're going to do is they're going to use these detailed account balances and look at basically the runoff, or how quickly funds get depleted from their account in response to what they call scheduled income events and unscheduled income events. So on the scheduled income, we're talking about wages and salaries with predictable arrival dates, basically your payroll. And then what they're going to call unscheduled income are tax refunds and fiscal transfers with uncertain timing. I think that the author should spend a little bit more time kind of convincing me that these are really unexpected in some sense. I mean, generally when I file a tax return, I know the amount, I have a pretty good sense of when it's going to come. It's something I think I can plan around. So I'd like to kind of have a little bit better sense of why you really think these are surprises that, you know, that they don't really see coming and can't plan around. But in any case, what they show in the data is that scheduled income is drawn down relatively quickly, while these unscheduled income remains in the account longer. And what they're going to do is they're going to create an inattention measure, which is the difference between the half-life of the unscheduled income and the half-life of the scheduled income. And what they show is that basically this actually correlates with their behavior when you have rate changes, that those who are actually more inattentive basically take their money out of their account at a slower rate in response to rate increases than those who appear more attentive in the data. Zhu led a little bit quick through this, but I think it's important to understand then that how this actually then gets applied to the bank level analysis, because there's a number of steps that the authors have to do to actually now run their bank level analysis. And again, it's because they don't actually see the depositor behavior at the bank level. So what they're going to do is they're going to have to basically use a projection. All right. And so what they do is they first estimate household attention in their transaction level data, and then they're going to project that inattention on household characteristics, right? So they're going to project it on demographic and socio-economic characteristics that are observed in both the transaction data and the IRS census data. So age, things like that, family status, and things of that sort. And then what they do is they aggregate this up to the county by income cell, okay? And then what they do is they look at call reports and they say, well, this bank basically has this amount of deposits in this county and this amount of deposits in this county. And then they're going to do a deposit weighted average basically across counties based on the county level inattention measure that they got from the socioeconomic characteristics in that county, okay? So this is how they do the aggregation, but it does rely on a key assumption, which is that banks operating in the same county need to draw from broadly similar local deposit pools. Okay, and I'm going to talk a little bit more about that, and I think the authors might want to do a bit more in terms of credibly showing that that's actually the case. Okay, and then what they're going to do is they estimate how deposit outflows respond to the deposit spread and whether that response is weaker for banks with more inattentive customers. The challenge is that deposit rates are chosen endogenously, so banks may raise rates when they anticipate outflows, which would create a standard endogeneity problem, so they're going to use a leave one out instrument, where that instrument for basically the rate gap for that particular bank is going to be based on the inattentiveness of their deposit base based on other counties, with the idea that basically these banks are using some sort of uniform pricing to set their deposit rates across all these counties. And the key conclusion then is that a one standard deviation higher inattention leads to 0.56% smaller outflows for a 1% higher spread. So they're going to basically conclude that banks with a larger inattentive population, they set lower deposit spreads and they essentially have lower pass-through of deposit rates. They're going to then have a model. The model basically is going to be quite simple. The banks begin with an existing deposit rate and then chooses the deposit rate to maximize the franchise value, which is basically just the federal funds rate minus the deposit rate that they pay. And the deposits leave the bank at some exogenous rate that depends on the spread between the policy rate and the deposit rate and depositor inattention. And they're going to basically be doing that trade-off. And the two theoretical results that the paper generates is this discount rate channel. This basically generates incomplete pass-through because when rates go up, basically that has a discount rate effect, which makes them care about the future less. And that then basically impacts their first order conditions so that they don't fully pass through the increase in the deposit rate in the federal funds rate to the deposit rate that gets set. I think that's pretty intuitive. And then they have this additional result on duration, on the duration of the franchise value, which they show is non-monotonic. And the idea is that when you're at the corner solution, basically when rates go up, because they're at the corner, they basically they're at the constraint, they don't change the deposit rate. So that basically has a first order effect on increasing the amount of revenue that accrues to the bank. Okay, and that actually raises the bank value. But then as the federal funds rate continues to go up, now you have an interior optimum. And now basically you have the envelope condition. So the only effect that basically remains at first order is the discount rate effect. And thus when the federal funds rate goes up, that lowers the franchise value and you get this non-monotonicity. All right, and then there's some quantitative results, which I'm going to skip, but they basically calibrate the model and they come up with, for example, an estimated deposit franchise of 2.6 trillion, and they show that a 10% reduction in depositor inattention lowers the aggregate franchise value by 186 million. Okay, now I have a few comments. So the first one is, I applaud the authors for having this really ambitious approach to basically trying to capture depositor inattention, which is really difficult to do with standard data sources. But I still find myself wondering whether their measure is really truly capturing depositor inattention. So we know, so first I've already made the comment that I'm a little bit concerned about whether they don't really anticipate some of these transfers coming, like tax refunds and fiscal transfer. They might not know the exact date. They know it's coming and they know the amount. But more generally, scheduled income can be embedded in regular budgeting and automatic payment routines. Whereas conversely, a household could observe a tax fund immediately, and let's say they truly didn't expect it coming, and then they leave it in the account while deciding what they want to do with it. If they didn't anticipate it, maybe they want to decide whether to pay down debt, but maybe what they want to do is, well, I have this unexpected windfall, and I basically want to go do some durable purchase with it. Well, I'm not going to move it to a money market mutual fund and then move it back to a checking account basically to do this durable purchase, so I'm just going to leave it in the account. Right? So that is, and what that means is, or I might just leave it as a liquidity buffer. And in that world, leaving tax refunds in a deposit account, it may actually be a deliberate, conscious allocation rather than some sort of delayed optimization that's coming from inattention. And more generally, this measure may combine inattention, which is what the authors are saying, but it could also be differences in pre-planning, mental accounting, which is basically they consider the tax refund a windfall that they want to spend, versus something that they need to cover normal expenses, liquidity constraints, and adjustment costs. So a few suggestions for the authors is the authors, one, might want to show these results, do some heterogeneity analysis where they show the results for households with high balances and existing brokerage or money market access, where liquidity constraints and access barriers are less important. I'd also like to know how much of the cross-sectional variation, the estimated half-life, comes from the scheduled income half-life versus the unscheduled income half-life. I know why you're doing this within person comparison to basically, take out these persistent effects. But really the story is that a lot of this variation should be coming from differences in these unscheduled income events versus the scheduled. So it'd be useful to have that decomposition of where the variation is actually coming from. And then most importantly, I would decompose the destination of the runoff. Look at actually basically those runoffs that are going to, for example, brokerage accounts. And what you'd really want to see, basically, which is really more tied to the theory, is that when you have an unscheduled event and a scheduled event, some of that is basically going to have a destination target of, let's say, a money market mutual fund. Do you actually see differences in those runoff rates when you actually decompose by the destination target? And I think that would be quite useful. On the bank level analysis, there's a number of concerns that I have, and I have some suggestions about how you might approach it. Number one is, as I said, the analysis crucially relies on this assumption that the banks basically have the same depositor pool within a county. But a large national bank may have quite different customers than a local community bank within a county, and the paper does very little to basically convince you in its current form that actually the depositor pool is the same. Now I'm going to play identification police. The issue, so there's some other issues potentially with the bank level analysis. One is that, as I said, you have to construct this inattention by basically projecting it onto observable demographic characteristics. But the concern then is that it's actually these observable characteristics which are actually basically picking up the sensitivity to the rate spread, right? For example, older people might have larger idiosyncratic preferences, let's say, over Bank of America or Chase. They might care more about the branch network than a younger person. Right? And that would then make them potentially more sensitive to the rate spread. Or younger people might need a larger liquidity buffer, which makes them less sensitive to the rate spread. Right? And so in general, how do we know that what's actually coming is the inattention as opposed to basically the demographic characteristics that you're constructing the inattention measure from? There's also some concerns with the exclusion restriction, which is that when a bank widens its rate gap due to other markets becoming more attentive, it may also shift customer acquisitions to the focal county, right? So you're basically assuming that, well, if the customer base changes and becomes more attentive elsewhere, which is basically how you construct your instrument, you're essentially assuming that's holding what the bank is doing in the focal county the same. But they might actually change some of their marketing, their marketing efforts in that focal county because they don't have to focus as much on these other counties. And thus then the index is constructed again from demographics, and those same demographics may determine how households respond to bonuses and other acquisition and retention efforts. So I have a number of suggestions here that I think the authors might benefit from tackling. One is to, again, validate that banks in the same county have similar depositor characteristics. Right now, the authors only have state by year fixed effects. I don't know why you didn't include county by year fixed effects. That would absorb a lot of these sort of county level shocks. So you should do a two-way saturated design with county by year and bank by year fixed effects. You should run a horse race between the inattention model and these other demographics that actually basically predict inattention. So you basically have a prediction model. You would say, here's the demographics which predict inattention. Run a horse race between those demographics and your inattention measure and see which one basically comes out stronger. The other thing is there's a mechanical concern, which is that they use the deposit weights, basically the contemporaneous deposit weights. So if you have a geographic shift from a attentive counties to inattentive counties, that would change your instrument, but it would be mechanically correlated with basically deposit inflows into the inattentive counties. So I think you should do a robustness check where you use pre-period branch locations and fixed baseline deposit rates. 5 minutes, okay. And then finally, a placebo you could do is you could construct the leave one out instrument using counties that the bank does not serve, but that are similar. That would then show some robustness that what you're not just picking up are general demographic and regional trends. So that would be a useful placebo test to do. Okay, on the model. So the model is interesting. I like the two results that the paper generates on the discount rate channel and the results on duration. But I think it is important to emphasize that the model in its current form is quite stylized. And it's not really an equilibrium model. It's really just a model of a simple monopolist optimization problem. And so to make this point clear, the model takes the deposit runoff as an exogenous function of the bank's rate and depositor inattention. So again, the bank is solving a monopolist problem. It's a very simple monopolist problem in the sense that also there's no structural modeling of new depositor acquisition here. You basically just have an existing depositor base and it runs off, and the interest rate that you set is going to basically determine at what speed your current deposit base runs off. And this then that changes how we might think about some of the quantitative results, and in particular the counterfactuals that they do. So their key counterfactual is a digital banking counterfactual. And the way they say that the digital banking counterfactual is it just makes customers more attentive. That's the one effect of introducing digital banks. But this outflow function, which they again just take as exogenous, is not a primitive object. It's really the bank's residual deposit demand curve, which is an equilibrium object that likely depends on bank competition and competitors' deposit rates, idiosyncratic preferences across banks, switching costs, and access to outside assets. And so when you do the digital banking counterfactual, that doesn't just potentially change the customer's inattention, it also expands the depositor choice set and improves access to alternatives. And moreover, if you then model the bank competition, right, then this residual deposit demand curve might change because it's not a primitive object. Reducing inattention may also intensify competition, change the value of a new depositor if you have basically modeled new depositor acquisition, and would in equilibrium change banks' pricing and acquisition strategies. What I thought I would then conclude with is what I think some of what the model might be missing is this notion of new customer acquisition. Because really what then you would be thinking, you would have your force, which is basically, I want to sort of exploit my current customers, but at the same time, I want to, at least in your world where you have this one tool, which is the deposit rate, you basically want to use that to basically maintain your deposit base and compete with other banks to get new depositors in. But then that sort of raises the question, well, an interesting question then is, well, how do banks actually compete for new depositors, right? And is the deposit rate the right tool to actually be thinking about by which banks compete for new deposits? So I have some new work with Ben Hebert and Matteo Benetton, which actually looks at this. And so what we did is we actually collected bank marketing materials. And so here's some, you've probably all received these in the mail, okay? Which is basically an offer to set up a checking account or a savings account. And what you'll see when you look at these marketing materials is they're not advertising the interest rate, okay? What they're actually advertising are sign-up bonuses. Basically, get $500 for opening up a checking account and setting up a direct deposit. And if you set up a savings account will give you an additional $300. And it's right there on the front page in big, bold text. And then you ask, okay, well, where's the interest rate in these marketing materials? It's right there, okay, in tiny, like 8 size footprint. And the reason they do it is because the interest rate is 0, okay? So what they're actually using is they're marketing using the bonus. So what we did is we actually collected this data from a company called Compare Media, and we processed this data in these marketing materials, and we looked at, maybe we were looking for pass-through in the wrong place, because I showed you those figures that said, well, if you change the federal funds rate, you basically get no action on deposit rates. Well, what happens is if you look at bonuses, well, you actually now do see some pass-through, okay? That basically the size of the bonus is changing with the federal funds rate. Now, it doesn't change, it's not a huge amount, okay? And that's because where actually the most pass-through happens is in the quantity of the mail that gets sent, on the extensive margin of actually sending the mail. For there, you see tremendous amounts of pass-through on this margin to the amount of mail that actually gets sent. And so what we did is we set up a model of deposit competition beyond rates. And the basic idea is we had, similar to the paper under consideration, we take seriously the idea that you have some sleepy depositors, but that you also might have some depositors who are more awake, okay? That there's some heterogeneity in the type of the customer. And now we allow banks to compete for new customers through bonuses and marketing, leaving the deposit rate equal. Bonuses and marketing, what you find there is you just leave the deposit rate equal to zero. It's an actually equilibrium result for the same reason as before. If I can compete for bonuses, now I'm much more if I can compete on this bonus to attract new customers, I'm much more incentivized to just keep the deposit rate equal to zero and exploit my existing customer base. And what we find is that then adverse selection rather than market power alone keeps acquisition offers low. And the other result that we show is that, well, the reason they don't want to pay, and this I'll conclude on this, the reason they don't want to pay the deposit rate and use the deposit rate to compete is that has large inframarginal effects, which if I'm going to raise basically the deposit rate, I've got to pay that deposit rate to all my existing customers. Okay, and that's very expensive. But the same argument actually holds for bonuses, which if I basically increase the bonus, now I don't have to pay that to my existing depositors, but it's a standard first order condition, basically, which is that if I raise the bonus, I have to basically pay a higher bonus to everyone. But what I can do, if I'm not fully exhausting the mail, I can just send out more mail, which we assume has this linear cost. And if that generates more customers, that doesn't have the same inframarginal effects. And basically, when we do this and we calibrate this model, we basically match the dynamics of rates, bonuses, and mailing quite well, which we find is that basically the deposit rate stays zero. The bonuses have some pass-through, but remain reasonably flat. But what actually changes a lot and where you see the most pass-through is in the quantity of mail, okay? And so just to conclude, I think this is a very creative paper linking depositor inattention to pricing, pass-through, and franchise value. Its strongest contribution definitely is this novel measure of delayed household adjustment. I think there are some outstanding questions that concern the bank level identification and the interpretation of the inattention measure. But I think in general, this is a very fruitful area to be working on, and we're just really starting to explore the multidimensional aspects of depositor behavior and the nature of bank competition. Thanks very much.
All right, so let's raise some round of questions. Yes, Jen.
I enjoy the paper. It's quite novel measure. So I keep wondering how much of the story is uniquely about attention or versus other frictions. So for example, suppose I'm banking with JP Morgan Chase. Maybe because of the local market is highly concentrated. Maybe I have a mortgage, I have a credit card, I have a business account. Maybe I just simply perceive the convenience or the safety. So I'm happy to accept the 10 basis point instead of this 500 basis point rate from banks like SVB. So there's many of these other reasons. In each of the case, I'm paying close attention, but I choose to stay put even. So a related thought is from the bank side. Tim also mentioned this briefly. So my understanding is many banks, they actively invest in relationship management. So they do advertising, they try to build up the ecosystem, they advertising on the mobile apps, whatever things, they are trying to reduce the sensitivity of the depositors to the rate. So it's not necessarily seems like attention or inattention is banks exploiting it. Rather, banks are strategically shaping the inattention. So I wonder, how do you think about this two-way relationship? Thanks.
I find there's a very interesting prediction from the model, which you showed at the beginning, which is the impact money policy on bank deposit franchise value dependent on the level of the discount rate. I find that super interesting because that implication is that depending on the current level interest rate in the economy, monetary tightening could have different implications on bank equity. Imagine deposit franchise value is a big part of bank equity. I'm not aware of other models predicting that. And I wonder if you can push this further by looking at the novel prediction across bank equity and how bank equity responds to money policy shocks on the conditional on the level of interest rate.
So Given the nature of the data that you have, I was a little bit surprised that you chose to focus on, these regular income shocks versus irregular income shocks, as opposed to focusing more on the level of the deposits. I would have thought that would be very informative. So if you have a household, for example, where normal expenses are $2,000 a month, and they hold $3,000 at the beginning of the month, then, well, you can explain a lot of that by their normal expenses. But if they hold $25,000 in their deposit account, then like transactions stuff is just out the window. I would have thought that would be very informative for these kinds of questions of why we see so many deposits, but that's not being exploited, I guess.
I was just wondering, given the granularity of the data, if you could tell us anything about whether the right model of inattention is this like Calvo thing or more like an SS model. Because I think like the literature, because we don't have the data, we kind of pick whatever is easier. But I think that distinction could have a very first order effect on franchise value when rate shocks are big versus small and whatnot.
All right, why don't you take these questions and then we raise another round.
Oh, first, thank you, team, for summarizing the paper so well and filling in some gaps. Okay, so I didn't have time to go through all of the results and points well taken. We should clarify some points that we already addressed and then think about the rest. Okay, in terms of the questions, the first question from Jenny. So first, whether banks or there is variation in inattention, how relation bank breed into this inattention. In the model, we completely only exploit this cross-sectional variation in inattention, and we didn't think about the dynamics of how inattention vary over time. That's definitely a fruitful direction for future research. And now on one house question, yes, we're very excited about this non-monotonicity in the model. And there are a lot of macro implications for this, including one recent paper by Ackenbaum that adds a background channel to generate some of the macro results. This is very simple mechanism to bake into more models, as you can see. And the third question comes from John. The reason why we look at this response to income is we consider this a more clear captures this inattention better, even though this could embed some other frictions. It's much cleaner to just look at the balances and how people respond to balance. It could be many other reasons. For example, you might have a bank account that gives you more convenience, as Jenny mentioned. And in using this difference between the two half-lives, we essentially strip out this bank level difference. And this is like one way to get around the identification police to say this is actually inattention rather than other reasons. But yes, we do see that there is correlation between the two, and the inattention does inform the balance of the depositor. They are correlated. And finally, the question from Lulu, that's an interesting one, whether it's Cavo or inventory model. Now, and that's what I think what you're alluding is whether people is state dependent, like whether people have more balances or larger income would react faster or more. That's one implication from what you had in mind instead of this Cabo idea we have. Then we actually test for the people with larger scheduled income and larger unscheduled income than scheduled, you don't see that they actually withdraw faster for that. So that's one way to go against this other manual cost or other model you have in mind. But just one last word on the inattention related questions, also relating to Tim's question on what is this inattention. I summarize that like there's three facts. Okay, so first is people are inattentive because they're sluggish in this unscheduled income response. And second, they respond slower to monetary policy changes. And then these banks also price these depositors, more inattentive depositors with lower rate. And all of this we think is most naturally explained by inattention. But how do you define inattention? Like if you talk about inattention, maybe the one narrow definition is people do not know the shocks. And that is one mechanism. But in our definition, this inattention is this broad umbrella word that we consider is just attenuated response to different types of shocks, okay, if they didn't expect it. And I think we cannot actually disentangle the different mechanism, whether it's mental accounting or approximation, etc. But these are interesting questions for the future work. Yes.
Like she has said the most important things. I just to fill in a few more points to Jenny's question. So yes, for sure, there are other considerations in the empirical part. We do control for, say, bank level difference in, say, number of branches and things like that. In a sense, we're actually over controlling because you are saying that inattention is sort of itself an endogenous object. For now, we're just saying let's figure out the residual part of inattention. Does that matter for bank pricing? Of course, then you can ask, what matters, what determines the inattention, and how do I get it in inattentive depositors? Then there's all this like follow-up questions. But to the first order, our questions after. We have this intuition that inattention matters. Does it actually matter? How does it matter? So that's our paper. Then to Wen Hao's point, I think it'll be very fascinating to sort of actually zoom into this duration sign flipping thing. I know of one paper in the JME that studies how sort of European banks' equity price response to monetary policy shocks at low versus high sort of rate regimes. They do find flipping signs. That's the only paper I'm aware of. But there's got to be a bit more work digging into say what is driving this sign flipping. Is it deposit franchise value or is it something else? I think our model would sort of apply similarly if you think about say low market power, because at the end of the day it's envelope type theory type of results. But then there are other assets banks hold. Yeah, to John's point, so there are pros and cons of measuring inattention using these responses. Like the pro is obviously that we nest out say bank level difference and other type of stuff. Specifically to the level of deposits, we actually did a lot of work on this to say that is level of the deposits the key driver for sluggishness, or is it inattention? Like we can run some horse race type of things. It turns out to be that inattention is driving the level of deposits rather than level of deposits driving inattention. But it's a statistical conclusion. All right. Is there any more questions?
So I guess there are two margins through which depositors can adjust, and one is taking their deposits to other types of accounts, and that's I think what your empirical analysis mostly focuses on. And much of the literature is about moving across banks, moving from one deposit to the other. And I can see a world in which you keep the amount of deposits relatively fixed, but there is a lot of movement across banks or vice versa. So I was wondering how you're thinking about, this type of inattention informing the moving across banks type of inattention.
I wanted to ask you a conceptual question related a little bit to the point that was raised in the discussion on bank competition, because it seems kind of natural that once I have an inattentive depositor, it's very valuable for me. Now, how that maps into the franchise, that's a bit different because we would, precisely because they're valuable, it seems we would compete for them ex ante very aggressively, maybe through signing bonuses or other things. And it seems a lot of these rents would be competed away in the end. So I was wondering how you think about this.
Any other question? Yeah.
I just want to throw in two suggestions I thought was very interesting, and a little bit following up on how deposit franchise is a great thing to have, but it's also kind of expensive. Banks have very large costs to maintain and invest in that franchise. So I'm wondering if taking those into account would change some of the conclusions and estimates in the model. And then the second suggestion was a little bit echoing Tim and maybe giving you a chance to respond to the extent that in the data, the inattention measure, the speed with which they run down their income shocks might have to do with things like liquidity constraints. It seemed like it would work against you because I would imagine that highly liquidity constrained households would be less rate sensitive and have other things to deal with. And so maybe if, given the richness of your data, you were able to actually control for that, it would strengthen and increase the magnitude of the cross-sectional results, which right now look a little bit small on the pricing. So just wondering about that.
Yeah. Any other question? So let me finish with one myself. I still feel there is a lot of questions about what is inattentiveness here, whether you capture it, etc. And I'm still uneasy with that in the sense that why don't you just call it stickiness? Why you don't just stick it with a stickiness in a way? Because it also raises the question of attention to what, right? Because you're capturing sort of attention to some sort of idiosyncratic shock, this income that are, but then you're extrapolating it to something that is much more aggregate, which is this monetary shock. So I don't know whether, even if you capture attentiveness in your way, whether it's the right attentiveness to capture.
Excellent. So let me start by maybe taking the first two questions on bank competition. So yes, so kind of related to Tim's point. So far the model does not have a bank competition, but that's sort of an intentional choice because we want to highlight that even if it's a monopoly bank, there is still competition between bank and non-bank, which pays a much higher sort of outside rate. Of course, competition might change things, but like our message to say to the first order, without like effects from competition, how does inattention matter? Then we can ask, how does competition modulate things? Empirically, we do control for concentration, other things in our cross-bank regressions. conceptually, there is a question of why doesn't bank competition eat away all these profits? Well, one answer is, first of all, banking sector is concentrated. There's a high entry barrier, so that's a cheap answer. A potential economic answer is, like as Tim said, there's a lot of adverse selection. So maybe it's impossible to target the right type of acquisition, the right type of customers to acquire. That'd be another reason why this kind of monopoly profits are not competed away. But with that said, we're very happy to sort of keep exploring this, especially considering bank competition in the presence of heterogeneous depositors. And then to Alex's point on deposit franchise value duration, we should clarify that which shows one channel through which this deposit franchise value duration depends on the level of interest rate. There are other channels that doesn't have sort of ambiguous dependence on the level rate. For example, if banks have large, say, fixed costs of sustaining their branches, then as you can imagine, a high discount rate lowers the present value cost of future fixed costs. This is going to unambiguously say that high discount rate is good, higher rate is good for a bank equity value. So there are other channels that are less sort of ambiguous. That's something we should like clarify a bit more. On the liquidity constraint point, yes, so we did a lot of work on validating what our measure actually is. One thing we did show that is, according to our measure, the most inattentive people, they also respond less. They also adjust their balance by less if there's a monetary policy change. If our measure is entirely or mostly driven by liquidity constraint, you might expect the opposite, right? The most liquidity constrained people, they withdraw their balance very fast. So we're gonna say that they're very attentive, but they don't have much balance. They don't respond very much to monetary policy shocks. So that would run counter to our interpretation. But I guess broadly, the more important point is, what are we actually capturing? Is it inattention, or could it potentially be some other things? Xu has mentioned that we did test, for example, against a view of with a fixed adjustment cost. There are potentially other things. I think one thing we are comfortable with is maybe you know the shocks, but you don't know what to do with it. Like there is an inability to make the optimal plan, which is sort of a focus of sort of emerging behavioral economics literature. Yes, it's right that we're measuring inattention as sort of inattention to income shocks, but we do all this validation exercise to show that inattention to income shocks does appear to sort of inform inattention to, say, monetary policy rates. It does inform sort of balance sensitivity to monetary policy change. And that's the object we need for the theoretical predictions.
Yes, so let me just, Sean already answered most of the questions. I just wanted to say, Alexi, we take your point very seriously. We actually did a lot of work, try to play around with different forms of cost and to try to see how it flips around this duration. As Sean pointed out, this fixed cost does flip the duration quite a bit, but the variable cost per dollar deposit doesn't. So I forgot to mention, in terms of one data constraint we actually have relating to Alex's question, is we don't observe the brokerage transfers very well. So ideally, the theory should directly map to transfer like this allocation between among safe assets, money or treasuries, or money market fund. But because we only observe the labeling of which brokerage goes to, like Fidelity, we don't see whether it's risky asset or risk-free. So we decided to just look at the balances instead of looking at zooming into the allocation of assets. And just one last word on why we call it inattention. Like I spent a lot of time thinking about the title of the paper. I really love the title, Banking on Inattention. I understand it's a very loaded word, but yes, you're right. End of the day, we're basically having this as umbrella word, just like stickiness. Yeah.
All right. Okay. So let's take a break and we'll reconvene at 11. Thank you very much.
Banco. Actually, Central Bank.
It's here. Yeah.
All right, so let's go with the final paper of the morning. Paul, you're up.
Thank you very much for putting the paper on the program. This is exchange rate stabilization and monetary transmission, and this is joint work with Alpsimsec, who's also on the audience. But the motivation for this paper comes from a standard tension that exists in international macro. On the first hand, there is a very clear theoretical benchmark in the Mendelian trilemma that states that with free capital mobility, you cannot have an independent monetary policy and a stable exchange rate at the same time. So the usual prescription that comes with this is to let your exchange rate float to absorb external shocks, and then use the resulting independent monetary policy that comes from this to focus on targeting the output gap. On the other hand, this is in stark contrast with what you see in practice, since in particular, many emerging market economies routinely manage their currencies using different instruments, including some that have a very good track record in the implementation of their monetary policy. So that stabilization always comes at the cost of monetary autonomy. That's the view that we are going to challenge in that paper. And so to do this, we're going to provide a theory of why and when can sometimes FX stabilization help monetary transmission rather than hurt it. And for this, we're going to shift the focus from autonomy, which is, can you move the interest rate in the direction that you want, to transmission, which is how much do you actually move financial conditions and then hopefully real outcomes when you change your policy rate. So theory is going to be as follows. We're going to work in a setup where the central bank is autonomous, they have full control over the policy rate. But for the real economy, they ultimately care about the yields on longer-term riskier assets. And so the transmission from one to the other is done by financial markets that are what we're going to call shallow, in the sense that there is limited available capital to do the arbitrage between the different assets. And the intermediaries doing that trade are facing risk limits in the tradition of general purpose. We're going to show that this leads to an inelastic demand for arbitrage, which then results in a weak pass-through of monetary policy from the policy rate to financial conditions. And so in that sense, the central bank might be fully autonomous, but they have very little control over the things that ultimately they care about, which is the output gap. In that setup, we're going to show that foreign exchange stabilization can help. By reducing the volatility of your exchange rate, you're going to bring in foreign capital. They're going to buy some of these risky assets that are usually on the balance sheet of your local arbitrageurs that are constrained. That's going to relax the balance sheet of these arbitrageurs, making arbitrage demand more elastic, and then improving the transmission of monetary policy from the policy rate to a real outcome. We're then going to fully try to characterize, and that's going to be the second contribution, the trade-off that the central bank is facing with that mechanism. So, the central bank might want to improve transmission by using a mechanism, but that comes at the cost of targeting a bit less internal shocks like aggregate demand shocks to actually focus on the exchange rate, which would introduce inefficient fluctuations in the output gap. Our second main result is actually going to show that there is no trade-off there on the margin. So it's always going to be optimal to introduce some level of FX stabilization, even when you start from a policy rule that only cares about the output gap. Okay, so in the sense, FX stabilization and monetary transmission are going to be complements rather than substitutes in that theory. But we're also going to show that there are limits to those arguments naturally in the model. And so you actually never want to go all the full way to pegging your exchange rate, because that's going to raise another source of risk, which is policy rate volatility, which would also tighten the risk limits on your arbitrageurs and weaken transmission. So in a sense, there is a sweet spot of foreign exchange volatility if you want to maximize the transmission of monetary policy. I unfortunately have to skip the literature in the interest of time, but before showing you the model, I just want to show you quickly some motivating evidence just to hint that we're going in the right direction. Okay, so inspired by a recent paper by Deleo Gopinath and Karen Yoskan that puts us on the way of thinking about transmission, they documented the disconnect between the short-term policy rate and what they call the market rates in emerging market economy, which in this case is the 3-month local currency government bond. Okay, so we're going to look at this pass-through when there is a change in the policy rate, how much that changes the yields on this market rate, conditioning on the level of FX volatility. Bin number 1 is going to be low volatility, bin number 5 is going to be high volatility, and we're going to, of course, exclude large depreciation in crisis events. And transmission seems to be peaking at its immediate level of FX volatility. We're going to repeat the same exercise, looking at a discrete measure of exchange rate regime using the Liszewski, Reinhardt, and Rogoff classification to find a pattern that closely resembles the one using just volatility. Then to verify that this is about broader financial conditions and not just about this particular type of local currency government bond, we're going to repeat the same exercise on stock market returns and find again a pattern where the transmission of monetary policy on subsequent stock market returns seems to be higher at intermediate level of volatility than at the other extremes. Okay. Now on to the model, which is the main contribution of our paper here. This is a setup and that we're going to use with the timeline at the bottom just for reference. Okay, so time is going to be discrete and finite, and at time 0, the central bank is going to commit to a policy rule. And then at time 1, 2, and 3, 2 different types of shocks are going to hit the economy. There's going to be a shock epsilon that pertains to the exchange rate, and the shocks rho that hits aggregate demand. Okay. Given these shocks, the central bank is going to set the policy rate in each period according to the pre-committed rule. And such a rule is going to lead international investors to expect some level of volatility, D of E3, at time 3 when the long-term bond pays off. They take this anticipated volatility into account to decide how much they actually want to buy of that long-term bond. That's going to be the D star in orange that you see here, a crucial number in that analysis. And then the rest of the supply B needs to be absorbed by these arbitrageurs that face financial constraints that I'm going to highlight in a second. Okay, so in the model, we're going to focus on the frictional pricing of this long-term bond at time 1 and the associated transmission from the policy rate IT to its yield R, which then ultimately matters for financial conditions and real outcomes, etc. Okay. Now, what is this shock epsilon to the exchange rate? It's simply going to enter as a wedge in the UIP condition. Okay, so you have the familiar UIP condition here. And one thing to note is that since we're going to look at the exchange rate from the point of view of foreigners, an increase in E is going to correspond to an appreciation here. Okay, and then you have the interest rate differential in the UIP condition. So if you increase your policy rate, that generates directly an appreciation of your currency. And if you have a positive epsilon shock, that corresponds, for instance, to an increase in the country-specific risk premium shock, that generates a depreciation of your currency, of course, because of the minus sign that's here. Now, at time 0, the central bank is going to decide on the rule that they're going to follow for the rest of the model, and we're going to focus only on linear rule for simplicity here. So there's going to be a weight, kappa R, that we put on aggregate demand shocks rho, and there's going to be a weight, kappa E, that we put on exchange rate shocks epsilon. If you take that interest rate rule and you plug it into the UIP condition, that gives you the level of volatility of the exchange rate you can expect at each period. And you can see, of course, that if you move kappa E from 0, which is the Mendelian benchmark, to closer to 1, you lean against fluctuation in your exchange rate using your policy rate, and that reduces the volatility of your exchange rate. Okay. So the first main ingredient of the model that we're going to keep as simple as possible, because that's not going to be the focus at time 1, all these foreign investors that are going to decide how much of the supply they want to absorb at time 0. Okay, and to do this, we're simply going to assume that these are mean variance investors that are risk averse and they value returns in their own currency, or in the dollars if you prefer, which means that they dislike the level of volatility of the currency, which is this sigma E square that you see here. That's naturally going to lead to a mass of entry, D star, the supply that you absorb as a foreign investors, to be proportionally decreasing with the level of volatility sigma E square. And so exactly like in the recent paper by Hassan, Mertens, and Zeng, if you stabilize the currency, you're going to bring in more foreign capital. The heart of the model, these arbitrageurs that are going to price the residual supply of the bond at time 1. We're simply going to assume that these arbitrageurs are CRA, but they have heterogeneous risk tolerance denoted by this tau that's here. They need to absorb the residual log supply B minus D star, which means the fixed supply, and D star how much was bought by the foreigners, and they have some level of wealth N. But additionally, they face some risk limits, meaning that the amount of risk they can take on the balance sheet is limited upward by this exogenous parameter sigma bar N. Now, as usual in this mode, because they're CRA, what they would like to do is take a quantity of risk, that's the equation that you see here, that's equal to the Sharpe ratio of the asset, that's the risk premium divided by the risk, scaled by the risk tolerance of that arbitrager. And one thing to note here is that the risk sigma I simply corresponds to the policy rate volatility, because this is a 2-period bond at time 1, that becomes a 1-period bond in the next period. Okay? Now, of course, if this quantity of risk, Sharpe ratio times risk tolerance, is higher than the risk limit, then this arbitrager are against the risk limit, and they cannot adjust their portfolio when there is a change in the risk premium. Okay? And we're simply going to denote by capital omega here with the bar, the effective aggregate leverage of the arbitrager simply by integrating their demand. So in that setup, the equilibrium is characterized by two natural conditions. There is first an asset pricing condition that states that the price or the yield of this long-term asset is related to the expected cash flow, which is simply the expected path of the policy rate, and the risk premium. That's the first equation you see here, asset pricing. And then there is a market clearing condition that tells you that the valuation of the asset, that depends on the price and the residual supply, must equal the amount invested by these arbitrageurs, which is why you have their wealth and their effective leverage there. And just to be very clear, you can see from the portfolio allocation equation that's here, that the effective leverage, of course, depends on the risk premium of the asset, and that's going to be the key object of interest. But the model is tractable enough so you can express the monetary pass-through in a very easy way. But it appears that the key object for transmission in that model is simply summarized in this E that I have here in the slide, which is linked to the elasticity of arbitrage demand. So how much is aggregate effective leverage moving when the risk premium on this risky asset is moving? Okay? And then the pass-through of monetary policy, which is simply, again, how much R is moving when I, the policy rate, is moving, is given by the product of two interpretable terms. The first one is the 1/2, that is simply corresponding to the exploitation hypothesis term. Okay, that's the usual standard transmission mechanism. Why 1/2? Because this is a 2-period bond versus a 1-period policy rate. And then there is a dampening factor, which is completely summarized by this E here. So why is it a dampening factor, and why is it that E is inside? The intuition is as follows. Imagine that the central bank is trying to stimulate the economy. They would cut the rate to do this. They would raise the price, the valuation of the asset, which means that arbitrageurs, to absorb the supply that's out there, needs to lever up. Of course, arbitrageurs are only willing to lever up if there is an increase in the risk premium to be compensated for that increase in leverage. And E is measuring by how much. But any increase in the risk premium, of course, puts upward pressure in the R, which is the long-term yield, and so dampens the impact of the rate cut that you implemented as a central bank. And so that's why this dampening has this E inside. Okay. Now, of course, if this E is very large, it means that your arbitrageurs are, very happy to very aggressively change the position for a small change in the risk premium. That's going to lead the dampening to be very weak. Okay. So that's why if E is very large, the dampening factor goes to 0. That's exactly what happens if you have a deep market. Okay, so think of a developed economy when arbitrageurs are wealthy enough such that none of them are constrained. We know that in these models, typically demand is very elastic. In our setup, it's simply E that's equal to the inverse of the risk premium. And so the expression for the monetary pass-through is the same as before, this 1/2 at the dampening factor, but that dampening factor becomes quantitatively negligible. So you can plug any reasonable number that you want for the risk premium. Think of this 3-month government bond that I mentioned before, and you will get a pass-through that essentially sits at the frictionless expectation hypothesis benchmark, which means that the central bank can fully control financial conditions with reasonable movements in the policy rate. Now, of course, the foreign capital entry margin is still here, so you can stabilize your exchange rate. You will get more of this D star. That's going to have a level effect on the risk premium, but essentially no effect on the transmission of monetary moves. This is going to be quantitatively different when you are in a shallow market, more relatively for emerging markets. Okay? When wealth is not high enough, then some of these arbitrageurs are going to be constrained. This means that they will not be able to change their portfolio allocation when there is a change in the policy rate, leaving the burden of adjustment to a smaller fraction of arbitrageurs. That's going to make market less elastic and so dampen the transmission of monetary policy. Okay? So the expression is exactly the same as before, but this E now is not quantitatively negligible. So just to put some numbers on this, imagine you have a risk premium of simply 4%. If you do the math, without this shallow market case, you would get a pass-through of basically 0.5. But if you also assume that 90% of your arbitrageurs are constrained, then the elasticity E is actually divided by 19, huge number, and so markets become extremely inelastic, and so the pass-through of monetary policy is almost divided by 2. Okay? Which means that if you actually want to set R close to the target that you have in mind as a central bank, you need very large movements in the policy rate, which might be costly for other risks. Now, why is it that foreign capital helps in that setup. I hope now this becomes clear. If you manage to reduce the volatility of your exchange rate, you have an increase in this D star. And so there is a smaller supply of risky asset that needs to be on the balance sheet of your arbitrageurs, which means that they will require a smaller risk premium for this. That's going to unconstrain some of them, and so giving you a higher fraction of arbitrageurs willing to rebalance their portfolio when there is a change in the policy rate, which is the same thing as saying that markets are no more elastic. And in theory, that also means that the pass-through of monetary policy is greater. And so you're going to have better controls over financial conditions and ultimately the output gap if you manage to reduce this risky supply. And so effect stabilization and money transmission are going to now become complements rather than substitutes. So the model is deliberately stylized, but it really rests on two different key ingredients that you need. The first one is that international investors dislike this foreign currency risk that's embedded in your currency. Okay, so in a sense, it kind of assumes in the background that these international investors are not fully diversified. That's consistent with a lot of recent empirical research, but also highlights the importance of the investor base in shaping the optimal policy of emerging markets. The second key assumption is that these arbitrageurs are bearing too much risk relative to what's out there to be absorbed in terms of supply. Okay. Now, some of you might already have some tension in mind, which is that in normal, this sigma I, as I mentioned, was the duration of the long-term bond. Okay, but the empirical evidence I showed you at first for motivation was about 3 months government bond, which typically carry very little duration risk. Okay. Now, the thing is, you can write OMOL with any type of risk that you want, and you will get exactly the same thing. So we apply sigma I with any source of risk that's embedded in the risky asset, liquidity, sovereign risk, or anything. You will get exactly the same thing as long as your arbitrageurs are constrained because that amount of risk is too high. And then that's consistent with the empirical evidence I showed you, thank you, on stock returns, and highlights that this is really about broader financial conditions and not just about the yield curve. Are these two pillars consistent with what we see in the data? We're going to do that very quickly just to check that we're going in the right direction. The first way to test one way to test the first pillar is simply to regress the share of foreigners in your local currency debt. And even with saturated controls, you can show that this is negative and statistically significant with the level of foreign exchange volatility. As a placebo, we're going to do the same thing with the foreign share of foreign currency debt and check that there is no relation here to make sure that there is no confounding factors there. To check that the second pillar is consistent with the data, we're going to construct a proxy for shallowness by looking at the size of institutional assets over GDP. And what we're going to confirm is that the transmission of the policy rate to this market rate is indeed lower when markets are shallow. That's the second line, negative and strictly significant. But also that the data is consistent with the highly nonlinear nature of the theory, right? FX volatility is going to be a problem only if your markets are very shallow. If you don't have shallow markets, then the transmission sits at the expectation hypothesis benchmark, and so you don't really need to worry about it. So that's the third line, and the fourth line confirms that the triple interaction is negative and significant. Okay. So now I explained one part of the motivating evidence I showed you, which is that if you reduce the volatility of the exchange rate, you can improve the transmission of your monetary policy. The one thing that was also on that graph was that if you go too far and you go towards pegging your exchange rate, it seems that monetary transmission goes back to zero once again. It turns out that the model generates that implication directly without adding any ingredient. And the reason is the following. When you stabilize your exchange rate using the policy rate, simply by increasing this weight, kappa E, that you put on this country-specific risk premium shocks, you're basically training off two different sources of risk. Yes, you're lowering exchange rate volatility that draws in the foreigners and that relaxes financial constraints on your local arbitrage. But at the same time, you now need to respond to very volatile shocks that are completely uncorrelated with the output gap. And that leads your interest rate volatility to be much higher. So that's an increase in sigma I, which, remember, also enters directly into the problem of the arbitrage. And so that second force is going to tighten risk limits and dampening transmission once again. So we show in the paper that the net effect on transmission is always the balance of these two forces. There is a foreign absorption and the interest rate volatility force. If you look at this for 1 minute, you will see that if you get your kappa E, which is how much weight you put on the country-specific risk premium shocks closer to 1, the foreign absorption term goes to 0 on the margin, while the interest rate volatility term is at its highest. And so that's why the volatility is going to dominate, that's going to backfire, and then your transmission is going to go back to diminish once again. So there is a sweet spot in terms of FX volatility if you want, because you need to trade off these two different sources of risk. Okay. So that's the positive theory of how you can improve monetary transmission by reducing the volatility of the exchange rate. The question becomes, do you actually want to do it if you're a central bank? And especially if you're a central bank that only cares about the output gap. Okay? So we're going to study this formally, by assuming that these shocks worldwide to aggregate demand are actually moving the natural rate of interest. So what the central bank would like to do is to bring this R, this long-term yield, as close as possible to its target, which is R star plus rho, and this quadratic form is simply penalizing deviations from a weight target. Then we're going to assume that the central bank also dislikes policy rate volatility with this chi term that you have here. So what's happening in this model, if you have shallow markets and then very weak transmission, your DR, the DI that's in this equation here is going to be very low. And so if you want to actually close the output gap, you need a very high movements in the policy rates, which means you need a very high kappa R that you see. So the product of these two needs to be closer to 1. Of course, you can always do this, but then it becomes costly in terms of policy rate volatility. And so you need to sit in the middle and not being able to close the output gap because of this. So the central bank is willing to use our mechanism to improve transmission. Then the question that remains is, do they want to do it? Because there's a trade-off between maximizing the strength of transmission and then abandoning some output gap targeting to focus on the exchange rate, which is going to induce inefficient fluctuations in the output gap. You're going to respond to shocks that are uncorrelated to aggregate demand. And so that's definitely going to create some fluctuations here. Okay? But perhaps surprisingly, what we show in the paper is that there's actually no trade-off, at least on the margin. And what we mean by this is that if you start from a Mendelian policy, what we call a Mendelian policy rule, so where kappa E is 0, then it's always optimal to raise your kappa E, so put some weight on targeting the exchange rate. How do we do this? We simply require the central bank to increase kappa E by reducing kappa R, so keeping the interest rate volatility constant. And then what remains is the cost of these inefficient fluctuations in not targeting enough the output gap. But we show that these costs are always second order if you near a rule that already responds to them. And so if you set that against the first order of gain of an increase in transmission, it's always optimal to introduce some level of FX stabilization, in a sense reversing the trilemma, which is the motivation I showed. Okay, so the first main result is that in that mode, you can increase transmission by stabilizing the exchange rate, but there are some limits to this that are embedded in the model. Second result is that even if you only care about the output gap, you actually want to use that margin and increase transmission by stabilizing your exchange rate. But more broadly, I think what we argued is that recognizing that the strength of the monetary transmission mechanism is endogenous is important, and in particular in that model, it depends on the distribution of risk holdings across intermediaries, which is itself an outcome of optimal policy. Okay, so thank you very much for your attention, and we're very much looking forward to Gita's thoughts on this.
Thank you. Discussion, Gita Gopinath.
So thank you for having me discuss this paper. And so let me just jump into it, which with the headline that I really liked the paper. I really enjoyed reading it. And why did I like it? Because it forces us to think again about this classic question, which is, are flexible exchange rates optimal? And I think every macroeconomist should have a view on this question, which is it a good thing to have fully flexible exchange rates or not? And what Paul and Alp do is spend a lot of time on in an important piece of this question, which is, does exchange rate stabilization constrain monetary policy? They focus on financial frictions of a particular kind, and Paul really explained that well, which you have shallow financial markets can impede monetary policy transmission. And their takeaways are that from an optimal perspective, some exchange rate stabilization can indeed enhance monetary policy transmission and monetary autonomy. They show you that there is empirical evidence that's consistent with that. And therefore, from a normative perspective, some intermediate level of exchange rate flexibility is optimal. So what I'm going to do, because is to start with situating the paper relative to the existing literature and practice. I mean, I think there is a lot of emphasis in the paper about Mundell-Fleming and what the recommendations are. So I thought it would be helpful just to set the stage in terms of what exactly do we think from the literature. When is it optimal to have fully flexible exchange rates and when is it not? And also in terms of the practice of, when the IMF is telling countries what to do, are they stuck with Mundell-Fleming or are they actually telling them to do something else? So I'm going to talk a little bit about that. So on the question of our flexible exchange rates, when I say our flexible, I mean like fully flexible exchange rates, are they optimal? The benchmark, of course, is that when you only have pricing frictions and classic Mundell-Fleming producer currency pricing, then in that world, and there's nothing else, there's no financial frictions, it's only that pricing friction. For all interesting cases, then yes, the answer is yes. You would like to have flexible exchange rates. And why? Because the expenditure switching benefit is very valuable, and that's how you close your output gap. And therefore, that's what you would like to do, is to just rely on flexible exchange rates. Now, the pricing paradigms can be different, and a lot of countries rely on the dollar when they trade with the rest of the world. And so, the dominant currency paradigm, which is basically that countries, when they sell to other nations, they set their prices sticky in dollars. And similarly, when they buy from other nations, they import in the dollar currency, which also tends to be sticky. And then the question is, does that change what optimal policy should be? And actually, it says that, and I put an exclamation mark there, because it says that even when it's dominant currency pricing, optimal policy calls for flexible exchange rates, right? So this is a little more surprising, because this is an environment where expenditure switching is not as powerful as under producer currency pricing. It's partial. You actually don't close the output gap, so you don't get full stabilization, but yet it is optimal not to mess with the exchange rate. And the reason for that is because monetary policy tools are not able to affect the external demand for your exports. Once the price is stuck in dollars, there's a foreign demand for it, for the good that you have. So you really can't affect that margin. So it's a great example of, that even if you have, even if your stabilization is less than perfect, it doesn't necessarily mean you want to deviate from flexible exchange rates. So then let's move away and let's add in financial frictions in there. And then the literature does have reasons why you would want to move away from fully flexible exchange rates. And I'm giving a couple of examples here, which is one is the case of when you have currency mismatch on your international borrowing. So if you borrow in foreign currency, if you borrow in dollars and you earn in pesos, then you get hit by a shock. Suppose you decide to cut interest rates, that's going to cause the exchange rate to depreciate. That's good, it gets you expenditure switching, but then you have to trade that off with that is going to tighten your borrowing constraint because of the mismatch that you have on your balance sheet. And so that kind of moves you to an internal solution where you want to have not as much flexibility as you would have had in the absence of that friction. There's a second case, which is closer to what Paul and Alp have, which is about if you have balance sheet frictions of the kind, some of the kinds that they have, and you have noise traders, then those are non-fundamental shocks. You don't want them affecting the economy. And so you actually use FX intervention to deal with those noise trader shocks, and you don't like the exchange rate bounce around in reaction to those kinds of shocks. So we moved away in terms, I think the literature has moved away from just the simple flexible exchange rates all the time, in theory. And in practice, the IMF has also now moved past Mundell Fleming to what they now have, what is called integrated policy framework. And I put this up as one of the papers that exists in this agenda, where this is the IMF's, if you go and click on this, it'll tell you what is the IMF's advice on the principles for the use of foreign exchange intervention, right? So it's specifically about under what circumstances is it okay, it makes sense to intervene, and when does it not make sense to intervene? And it is building off of the papers that have been written in this. This is a recent change, so it's okay if Alp and Paul didn't catch up with it, but this is where it is. So I'm going to discuss this paper through the lens of the integrated policy framework, because that's how, I think that's where the frontier is in terms of also the practice of this particular question. Okay, so the integrated policy framework is basically the way you would think of it when you're advising a country, or when you're thinking of it even on pencil and paper, is you say, okay, what are the shocks that hit the country? What are the frictions that this particular country is dealing with? And this is very important, what are the policy instruments that the country can use, right? And the recommendation is a function of all three of these things. It depends upon the shock, whether it's a fundamental shock, it's a non-fundamental shock, depends on the kind of friction, what is the trade-off that you're dealing with, and it depends on what policy instruments that you have. So in this paper, there are two kinds of shocks. There are demand shocks, which I would call like fundamental shocks. And then there are shocks to UIP, which are, in a sense, non-fundamental shocks. They don't affect the output gap directly. They're just bouncing around your exchange rate, which is what you don't like, right? So there are two kinds of shocks. Frictions, this is the main portion of the paper has a lot of very reduced specification and a lot of reference to please see Appendix C.1 for microfounded versions of those equations. I didn't go and read every single one of those, so maybe you can clarify that through the paper, but it would help. So there's implicit price stickiness because there's an output gap, and I'm sure there's an appendix that models that. The one that they really focused on is the shallow domestic financial markets, which Paul explained really well. Then there's a UIP wedge, that's stuff moving around. And then there are foreign investors who dislike exchange rate volatility. I think you could write a model which it's not a friction. They do dislike exchange rate volatility, but the way it was specifically introduced in, I couldn't tell exactly whether it was creating a wedge or not. Okay, so there are a few frictions, but importantly, there's the pricing friction and there is a set of financial frictions. And then there's a policy instrument here, and here it is important because the policy instrument is basically the interest rate, right? And the interest rate is set by an interest rate rule that depends on that is a function of the demand shock and the UIP shock. And of course, kappa R and kappa E can be chosen optimally, which is what they do at the end. I'm less concerned about the fact that they have a particular form for this at this point. The IPF actually does everything in a nonlinear fashion, but here, so I'm okay with this, but there were a couple of things I think this is important. One is that there are restrictions in terms of the instrument set, and this is important. For one, as you know, there is a desire to smooth the interest rate. So this is an environment where even if you had no financial friction and the only thing was a pricing friction, you would not like a lot of exchange rate flexibility because of the fact that there is this ad hoc parameter there that tells you that you want to smooth interest rates. Now, I'm not sure why you need that because you have a reason why you don't like interest rate volatility otherwise. So maybe you could take that off, but leave it to you to do that. The second one is also very important, and I'll come back to why, which is that there is no sterilized foreign exchange intervention in the setup. And I'll come back to it, but the simple idea is, as Paul explained, there is a trade-off between trying to get exchange rate stability and interest rate volatility. So whenever you try to dampen the exchange rate volatility, you end up increasing interest rate volatility. That would happen in a world where you only have the interest rate as an instrument. But countries, what they tend to do is they use FX intervention to deal with the exchange rate problem and kind of disconnect it then from the interest rate, right? So you break that link. Okay, so now let's think of the problem that the central bank is trying to solve. The central bank has this loss function, which is expressed, so the squared term is the output gap squared. And importantly, it is the difference between R, which is the market-based interest rate, and a R star, which is what you would expect it to be in the absence of any shocks in this environment. But obviously, that's the long-term R star, but you can have a cyclical R star, which moves around with the rho, which is the demand shock, right? So rho is the demand shock is the only thing that enters the loss function directly. And importantly, the relevant rate that matters for the output gap is the market rate, which I think is perfectly good. I mean, that makes a lot of sense. That sounds right. And then you have this other piece over there, which is what's giving you the interest rate smoothing, that you don't like too much volatility in the interest rate. The output gap, therefore, depends on the market rate. And there's a policy rate that's being set. We know that equation. But the market rate is now linked to the policy rate, which in the standard ways. But there's also this risk premium term that's floating around. And Paul explained exactly what that risk premium term does, which is that, and why it can dampen the transmission of I to R, right? I mean, I think that was super clear, so I don't need to explain that again. And what we know is that the risk premium is decreasing in sigma squared E and it's increasing in sigma squared I, right? So the trade-off is basically that when you reduce the volatility of the exchange rate, if the central bank reduces the volatility of the exchange rate, you attract more foreign money into the economy. That makes it easier for the domestic arbitrageurs to do their job. And so that's good and reduces risk premium. But on the other hand, it is increasing in sigma squared I. By the way, it's not always increasing it. You need some parameters to fix that. I'm not going to go into that. But you can, under a set of assumptions, which are fine, that you end up with actually it going the other way, which is that if you have too much volatility in the interest rate, that the domestic arbitrageurs don't like that either. And that makes their risk premium go up. Okay, and so that's the trade-off that you have. And so you get this nice picture which basically shows you have an inverted U shape of monetary transmission, which is that if you put kappa E to 1, which is basically you're reducing the volatility of the exchange rate, then you're creating a problem with increasing the volatility of the interest rate. So that's not perfect. If you go to the other extreme and you have literally no intervention in the exchange rate market, then you gain in terms of reduced volatility of the interest rate, but then you lose in terms of the foreign investors coming into the country. So there's some optimal level in between for kappa E in terms of the monetary policy transmission. Okay, so now optimally choose kappa R, and now that was just the transmission, and now we have to ask ourselves the question about what should be the optimal policy in terms of kappa R versus kappa E in terms of flexibility of the exchange rate. So you could ask the question, which is, okay, this is wonderful. You have this relationship between monetary policy transmission is a function of the exchange rate volatility. So can I just do the opposite and just move my interest rate around to offset that? So the actual interest rate that the markets face is exactly what I want it to be. And that's where the variance of I, the fact that you don't like volatility in I as a central banker comes in. But again, just to push the point that I'm not sure you need that in there because you do have another reason why volatility of I is a problem. So something to think about, right? Then the conclusion of the paper says that it's optimal for kappa E to be greater than 0. Completely understand that point. There's a reason why you would want to move away from having completely flexible exchange rates because it's going to attract more foreign investors. And then it says you don't want to have excessive stabilization. But the way Paul presented it was saying that you don't want to have excessive, you don't want to go to the extreme where you're making kappa E too high, because then you're increasing the volatility of the interest rate and that's going to dampen the monetary transmission. That is correct. But I don't think you need that for the normative result, because the normative result has an expenditure switching reason why you like exchange rate flexibility, right? So even if you didn't have this trade-off between the volatility in I and the volatility for monetary transmission, you would still get the fact that it would be, you would stop at some point, that you would not go to the extreme and have a pegged exchange rate because of the exchange. But I understand you're trying to explain the monetary transmission, so the nonlinearity. So this is what just spelling out in the paper, because it kind of gets lost in the discussion. Okay. And then on optimal policy, yes. So this is, I think I already said this. I don't know how much time do I have, like 2 minutes or something? Okay. Is the lack of foreign exchange intervention instrument really does matter over here? Because if the central bank, which is what the central bank does, it uses FXI to stabilize the exchange rate and responds to exactly these kind of non-fundamental shocks, these psi shocks, E shocks or whatever, and that breaks the link between the volatility of the interest rate and the volatility of the exchange rate, and it frees up the interest rate to just focus on the fundamental shock. Okay, so, and obviously the advice always for countries when they go to the IMF is that, can you please deepen your financial markets and work on that? You can't tell a country that's in a crisis, please go and deepen your financial markets, because that's not the time. They can't do it. And so you're right that the kinds of things you're talking about are very important, but then over time, obviously, you want them to move away from it. So then I mean, again, what's cool about the paper is it goes and looks at empirical evidence. This is the paper that they're kind of, they relate to, which is a paper that I have with Pierre and Shebnem, which is where we basically ask this question about monetary policy transmission. And it's an empirical paper that shows that there is, indeed, it is correct that there is imperfect monetary policy transmission. If you compare emerging markets to advanced economies, if you just look at the top two graphs, what we basically say is that when there is an increase in growth rate in an emerging market, the policymaker ends up raising interest rates, its policy rate, but often the market rate can actually go down, right? So you have periods when higher growth rate and the monetary authorities trying to raise interest rates, but the transmission is not working very well and it goes down, which is not a problem for advanced economies. In our paper, we then tie this, like there's variation in this particular pass-through, and we tie it to external funding and variance in external premia. So maybe there is some parallels between that work and this work here in terms of just the evidence. I think what Paul and Alp do is say, okay, there is incomplete pass-through, and can we tie it to exchange rate volatility and exchange rate regimes? And they show, yes, like in the theory, you get this particular inverted U shape relationship between the two. So this is not something that I have seen anybody else look at. It's not, this relationship. So I think these guys get a lot of credit for looking at this relationship. Okay, so from emerging markets, monetary transmission increases and then decreases with exchange rate volatility. So I don't think Paul and Alp are trying to sell this as, smoking gun evidence. And frankly, I think we do ourselves a disservice in macro by only writing papers with smoking gun evidence, trying to write some papers with smoking gun evidence. So I'm perfectly fine with not having that. But just a few things that I might ask you to do, which is one is, you said you look at 16 emerging markets. I couldn't tell what was the sample selection criteria. How did you do that? Secondly, your theory and the model as written is all about long-term bonds. You have a very nice footnote that says that you can write everything in terms of short-term bonds too, but pick one so that the evidence and the theory are the same. And maybe you could put country fixed effects in there. I mean, it's just one thing because right now it seems a comparison across different countries. So I will conclude. It's a paper with a lot of good food for thought. I think this digging into the monetary transmission mechanism, highlighting the differences between emerging and advanced economies, very valuable, and kind of providing this very interesting mechanism. There's novel theory, novel empirical work on an important topic, and I look forward to the next version.
Thank you. Right, so let's raise some questions. Lexi, you.
Thank you. Very interesting paper. I just want to clarify one part of the mechanism that is important, but also a little counterintuitive, which is this dampening idea. In most intermediary-based asset pricing models like Marcus and Arvind's and others, there's usually amplification. If I cut interest rates, usually the intermediary's net worth goes up, and so their risk-bearing capacity increases, and that causes risk premiums to go down. And so the total discount rate goes down, both because the rate and the risk premium went down. In your case, when the rate goes down, the risk premium actually goes up because they somehow become more constrained. And that seems to be very important because if you switch to amplification instead of dampening, then your conclusion would also change in terms of whether we should be stabilizing or not stabilizing the exchange rate. And so I'd just like you to comment on that mechanism and why you think it's the right one and how robust it is. Thanks.
Thank you for the paper and that discussion. It's a quick question about the instrument set. So there's, as Gita mentioned, you're basically shutting down FX interventions completely. So this is emerging country currencies, and they do a lot of stabilized intervention, meaning that holding monetary policy rates. Just want you to comment on how do you think about the key figure of the paper, how the U-shaped inverted curve will change if you introduce interventions for the instrument set.
Yeah.
super interesting. Beyond the intensity of abstract capital, can you also incorporate potential heterogeneity or composition of arbitrage capital in terms of like one, because I understand right now you look at the share of institutional investors, but 1% share of mutual funds versus hedge funds or pension funds could be completely different in terms of how they transmit monetary policy. I guess there is a very nice job market paper by Sage Bells, I think she's here as well, and talk about some of the trade-off you also highlighted in terms of exchange risk and interest rate risk. And relatedly, there's also a notion of how globally integrated, especially hedge funds, because I would have saw most of the hedge funds are just US based. If that's the case, then maybe that's also related to your job market paper in terms of like different countries, right? Because they are also subject to the same hedge fund capital globally, then there could be also some interesting thing to explore. Thanks.
Very cool paper. Related to Alexi's point, I suspect the reason that you have this dampening force is related to this standard mechanism in preferred habitat and related models that typically the behavior of the other side will induce flows on the balance sheet that generates this dampening. And I think the sort of amplification that he was referring to exists in richer models that either have reach for yield type behavior or the kind of wealth effects that he was alluding to. But setting that aside, I wanted to ask about actually what we think we know about the conditional responses of risk premia in this context to policy actions in emerging markets. I couldn't quite follow from the empirical evidence you showed, but it seemed like it was not conditioning on monetary surprises. It was just movements in the policy rate. Maybe this is also a bit of a question for Geeta and co-authors, but the way she described her evidence, it seemed like one could tell a story about there's good times in EMs, they raise the policy rate, but at the same time, those good times imply risk premia fall, and that's why the market rate does not go up 1-for-1 with the policy rate. I would say that is interesting, but distinct from the conditional responses of a change in the policy rate in EMs on risk premia. And so there I sort of agree with Alexi. It would seem my read of the broader evidence suggests that it looks like there's amplification. And so if you could speak to that.
So why don't you take this one and then we'll raise some other questions.
So thank you very much for the questions. Thank you very much, Geeta, for the excellent discussion. So why do we study dampening? Why do we assume that there is dampening in the model? The easy answer is that if there is amplification, then you really don't need to worry about the transmission of monetary policy, right? Even smaller movements in the policy rate would translate into bigger change in the long-term yield, and then very easy to target the output gap. Okay, but the empirical evidence that we show seems to have a very low pass-through for many of these countries, which is why we need a model with dampening. Otherwise, and you're right, but otherwise, if this is not a problem, then maybe you want to do the opposite to even more maximize transmission. But if you have overreaction of long-term rate, it's not really something you should really care about, at least in this model. But connecting to one question, it's true that we only have changes in the policy rate. We only have changes in the policy rate, not monetary policy shocks. If I remember correctly, in your paper, Geeta, you studied the response of interest rate because to a US monetary policy shock, so that's why it's honest. We don't have that. We would like to have it, but we don't. And again, in that setup, it seems that the pass-through is very limited, which is a problem if you believe that you want to target the output gap. So I think, but we can talk more about the evidence that you have in mind. I'm not really familiar with it, but they'll be interested. Very quickly on, so why do we use these insertion assets over GDP? That's the proxy that we found. We can probably do more on this and check the duration holds. To the link with global hedge fund, this is interesting because so in the model that we presented here, the foreign investors are really not doing any much, right? They just buy some supply and then they wait, and that supply absorption translates into a relaxing of financial constraints on the local arbitrageurs. In the appendix, sorry for all the appendix, Geeta, but there is maybe a more complete version when these foreign investors are also reacting to monetary policy changes, and we show that this also amplifies the effect that we have in mind. So if you stabilize the exchange rate, you're going to get a more elastic response of foreign investors, which are maybe the global hedge funds you have in mind. That's also going to help make markets more elastic, improving the transmission of monetary policy. Actually, the two elasticities just add up in the model, and that makes things even better. It's just a more complicated model, but I think that's what you have in mind. And then finally, let me comment on the instrument, because that's the point that Geeta also raised. We focus on the policy rate for simplicity, of course. I think it's 100% true that in the model, if you had access to reserves, then you would like to use them because then there is no trade-off. You stabilize the exchange rate, you deepen markets, and then the policy rate only focuses on look at that. That's the better of both worlds. I think the reason we really want to study this rule is because the way this works in the model is really through the expected volatility of the exchange rate and not simply about what the exchange rate is doing today. So you need your foreign investors to believe that the exchange rate is actually going to be stable in the future when they exit, which means that if you have limited reserve, you need to have something else to make sure that you can respond to large shocks, and that is probably the policy rate. And so, even if you have access to reserve, if these reserves are limited, then you need the interest rate to back up this credibility that you're trying to put in place by stabilizing exchange rate using the policy rate. I think that's what we are in now.
Thanks, Paul. Let me just add a few minor things. So I think, Alexis and Rohan's questions on dampening versus amplification is important. So the model is stylized, but the right way to interpret this is a situation where these arbitrageurs are net buyers of assets. So when an increase in asset price, it sort of tightens their constraints. So we think this actually in normal times, this is the typical situation. There's a flow of assets they need to absorb. So the other amplification case happens typically in crisis, like fire sales literature is about that. That's a situation where arbitrageurs get suddenly tight constraints and they're forced to sell, and then the asset price drops further, tightening their constraints, etc. We think that can apply in crisis situations, but I think in normal times, this net buyer assumption is the more typical case. There's actually a nice paper by Alberto that's going to be presented later today in the program that makes this distinction. So that's one of the key things. The other thing is we're sort of changing the policy rule. So there's a surprise rate hike that's more likely to hit the arbitrageur balances. But if it comes as part of a rule, again, thinking outside the model, that's less likely, I think, to be tightening. And just to say a few things about Gita, thank you so much for a very nice and constructive discussion. I agree with basically everything you say. In terms of why we need this gradualism term, it seems to be like an empirical thing that central banks don't like to adjust interest rates very much. So we sort of take it as given. But I think you're right that we may not need that, especially for emerging market contexts. You can imagine policy rate itself actually matters for transmission, because for these countries, deposit rates, short-term rates are actually also important. So then if it's a mix of long-term and short-term rates that matter for financial transmission, I think that model would naturally get us what we want without an auxiliary assumption. In terms of exchange rate expenditure switching, whether it gets us what we want, I think actually expenditure switching goes in the direction of our results in the following. So if you had expenditure switching to the model, because E in the model is driven by these UIP shocks, these are things actually you want to push back against. If you have like fundamental shocks to the exchange rate, I think you're right. We want to sort of some exchange rate volatility would be good. But in the model, exchange rate volatility would also be bad because of you want to push back against these UIP shocks. And why the other question of why we don't use FX interventions, you're absolutely right. That's why, and I'm from Turkey, that's what Turkey or these countries typically do. We kind of wanted to set the deck against us and show that even with interest rate policy, there is room to stabilize the exchange rate. If you expand the policy tool to include FX interventions, I think the case for stabilization becomes even stronger. But you're absolutely right that we should probably model that as well. And that will actually further help to unleash the interest rate for domestic stabilization. But overall, thank you for very nice comments.
Any other questions? Yeah.
Great paper. So my understanding is here the financial market deepening is the key. Along the key insight, like typical Venezuela model, if you allow the arbitrageurs to be less risk averse, then there's more integration across the bond market. But I want to highlight that it seems that exchange rate stabilization, there are multiple ways of doing that. In the paper, it's really about the central bank using the policy rate to stabilize it. In reality, there are other ways to do it. One way is to do capital control. But I find that that's kind of a risky move in your model, because if they do capital control, actually it's counterproductive to transmission, because then the foreign investor will be less willing to enter in the first place. The market will be shallower. So I feel it's not unconditionally that more stable exchange rate would lead to more integrated or stronger monetary transmission. It also depends on what policy instrument the central bank is using. Like in your model, I think using the capital control is actually counterproductive.
Any other question? So that says it. All right. Go ahead.
I think that's correct. Yeah, using capital controls, if you prevent the foreign from coming, then you're gonna actually make the market shallow. So I agree with that. There are no other questions, and we are allowed to respond to the discussion. I might also add, so first of all, that we do have an appendix that microfunds, exactly like Alp was saying, right? So the baseline version is agents care about the long-term rates, and so that creates this policy rule. But you can also assume that there are two classes of agents, one that care about the long-term rate, and one maybe the depositor that care about the short-term rate. And so that's why you want to be in between, moving too much the policy rate for that second class of agents and moving the long-term rate for that first class of agents. So that's true. There's one thing I wanted to add because you mentioned it, which is why do we use the sample of 16 countries? Because I think that's your sample when I read your paper. So it's the same thing. I actually use your Bloomberg code, tickers to actually get the data. So it should be the same thing. I want to quickly mention something, even though, unless there is another question, but relative to the literature that you mentioned. So we are aware, of course, of the IFF and all the other works. I think one thing we try to do in that paper, the way we set up the problem, is that we're really trying to set up the problem such that the exchange rate in itself has absolutely no impact on real outcomes. There is this QRQ question that moves around, but if you look at the way we microfund the output gap, these things is completely irrelevant. And yet, despite this, you still want to stabilize the exchange rate for completely other reasons. So, and that's why it's a bit different from the currency mismatch case, where changing the exchange rate changes real outcomes because of that direct channel. In our case, there is no direct channel. And if, despite that, you still want to stabilize the exchange rate. That's the thing I wanted to mention.
Thank you. So before we let you go for lunch, just an announcement. The Money, Macro, and Financial Frictions workshop keeps going in the afternoon in the other tower in Charles AB. We have changed, as you know, there is a semi-final today. It's Argentina and England. Yes. Now I remember. So we moved the program to start at 1, no breaks. So we're gonna end sort of in time to get to the game. All right. See you in the afternoon. Thank you.